All right. Now, before we move forward, I have a very important rule which I need you all to follow throughout the session. And the rule is very simple. Throughout the session, I'm going to be asking y'all a bunch of questions. Now, when you give me answers to these questions, I want y'all to be completely honest with your answers. Can you all do that for me? Yes. Please type. I don't want anyone sitting there thinking, dude, no, if I ask this, if I say this, if I ask this question, he might think I'm stupid. No, right? That is not happening. Trust me, I really want you all to keep asking questions, right? Now, one thing I'm going to guarantee you is that I'm not going to move on to a new concept without making sure every one of y'all understand the concept properly. Cool. Now, to make sure that happens, it is very important for me that you keep this session interactive, right? I don't want this session to be, very to be looking like a college lecture, right? I want this to be as interactive as possible, and that is what we are going to be doing. That is one, right? Tell me everything honestly. So, my first question. How many of y'all are completely new to stock trading? If you're completely new to stock trading, type new. If you've been trading for 4 years, 2 years, type 2 years, 4 years, 6 months, whatever. Type go. New, 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 new. 2 years, good. 5 years, nice, good. 6 months, 3 years, 6 months. New, new, new. 6 years, 2 years. 6 years, good. 6 months, 6 years, nice. 3 years, 2 years, 1 year, 3 months, 3 days. Okay. 6 months, 3 months. All right. Perfect. So so majority of y'all, I think, are new, but I see a few people who have been trading for quite some time, right? Mm, f- don't worry, that's completely fine, right? So I'm gonna name a few concepts just to understand how much you know about the market till now, right? Um, I'm gonna name a few concepts. Type yes if you understand this concept properly. Type no if you do not. All right. Number one, market structures, your basic higher high, higher low for an uptrending structure, lower high, lower low for a downtrending structure. Type yes if you understand this concept properly. Type no if you do not. Yes, very simple, very easy. Perfect. Awesome. Everyone knows this. Perfect. All right. Number two, support and resistance. Type yes if you understand the concept properly. Type no if you do not. Yes, yes. Very easy. Oh, I see a few no's. Okay. Okay. All right. What about breakouts? Type again another very basic concept. Type yes if you understand breakouts. Type no if you do not. Yes, yes, yes. Okay, I still see a few no's. What about liquidity? Type yes if you understand liquidity. Type no if you do not. Okay, then what about imbalance? Imbalance theory, price deliveries and all that? Type yes if you understand it. Type no if you do not. Not fully? Kind of? Okay, understood. Understood. Now, guys, the people who have been trading for, 2 years, 4 years, 5 years, whatever, is it fine if I take the first 15 minutes of your time while I explain the basics to the people who doesn't know all these concepts? Is that okay? Trust me, wait 15 minutes. You are going to, if you've been trading for 4 years, 5 years, does not matter. By the end of this session, you are going to learn so much more than what you've learned in the past 4 years. Trust me. All right. So for the first 15 minutes, let me break down the basics for the people who doesn't know what these concepts are. I'll be quick. Don't worry. We'll get to the juicy bits in a little while, in 15 minutes. All right. Now, we are going to start with market structures. Again, I'm hoping everyone knows, right? Market, if it's an uptrend, it'll create higher high, higher low, higher high, higher low, higher high, higher low, higher high. Right? That's your higher high, that's your higher low, higher high, higher low, higher high, higher low, which causes an uptrend. Correct? That's your market structure. That's an uptrending structure. Correct? Now, if it's in a downtrend, what happens? There will be a lower high, lower low, lower high, lower low, lower high, lower low, right? So that's your lower high, lower low, lower high, lower low, lower high, lower low, which makes it a downtrending market structure. As simple as that, right? Now, when it comes to support and resistance, What is a support? What is a resistance? Again, very basic concept. So let's say this is you right here. This person right here, that is you. Okay, this is you. Now, in your hand, you're holding a ball, a cricket ball, and you're standing, let's say you're standing in front of a wall, right? You're standing in front of a wall. Now, what are you doing with this ball? You are throwing this ball onto the wall. What will happen? The ball will hit the wall and it will bounce back. Correct. Now, in this scenario, what is responsible for the ball to bounce back? This wall right here. This wall right here is responsible for the ball to, bounce back. Now, exactly the same way, in the stock market, there are imaginary walls, right? There are imaginary walls. I'll tell you, don't worry. See, right now, if you see the chart right here, everything that you see here is very random, right? Market's going up, it's going down, it's doing all of this, it's going down, doing this, big fall, reversal, big fall. It's creating a lot of random up moves and down moves, right? By the end of it, we are going to make sure we understand how to read this properly, right? Now, that is what we'll be focusing on, right? For the time being, like I said, everything is random to you. Now, let's say I have an imaginary wall right here. And let's say this imaginary wall is sitting at 100 rupees. Okay, let's say this is sitting at 100 rupees. And let's say this is how the price is moving. This is how the price is moving. It's moving, it's moving, it's moving. And it taps into the wall. Let's say the price started from 50, right? So for some reason, when the price reaches 100, it hits an imaginary wall, and what happens? Price bounces back. Again goes up, hits the wall at 100, again comes back down. Again goes up, hits the wall, bounces back, hits the wall, bounces back, right? So something's there at 100 rupees, which is causing the market to bounce. Correct? Now, my question to you is, guys, would you agree if I say that for the market to go from here, for the market, for the price to go from here till here, would you agree if I say that right here, a lot of buying should have come through there? Would you agree? A lot of buying should have happened here for the market to go from here till here. Would you agree? Would you agree? For the market to go from here till here, a lot of buying should have happened right here. Now, similarly, if you apply the same logic, right, for the market to go from, for the price to go from here till here, what should happen there? What should happen there? For the market to go up, if buying should happen, for the market to go from here till here, a lot of selling should have come through, right? A lot of institutional selling should have come through, right? If that is the case, this wall, what is essentially happening there? Something is selling. Every time price reaches 100, selling happens. Selling happens. Selling happens. Selling happens. At this moment, we don't know what is causing the selling, right? We don't know. We have no clue. We just know that someone out there is selling every time price reaches 100, and it is pushing the price back down, pushing the price back down, pushing the price back down, pushing the price back down. Correct? Now, my question to you is, would you agree if I say that the market is resisting the price from going any further than 100 and it's pushing the price back down? Would you agree? Market is resisting the price from going above 100. It's resisting the price from going above 100, it's pushing the price back down, right? And that is exactly the reason, that is exactly the reason why this level right here, this imaginary level right here, is called a resistance level. Now, what do we know about resistance level? That resistance levels are caused by selling. Now, this much we understand about resistance levels, right? Resistance levels can act as walls. Right now, my resistance level here is sitting at 100 rupees. Every time price reaches 100, the price is bouncing back down, and the bouncing back down, that move down is caused by selling. This much we understand about resistance levels at this point. Till here, is this clear for everyone? Yes, understood. Type clear. Perfect. Perfect. Now, our concept, right? What is the topic that we were covering? It's called support and resistance. Now we understand resistance. Now we have to understand what is support. Now, support is exactly the same thing as resistance, but just ulta, right? If your resistance is going to be at the top, your support levels are going to be at the bottom. For example, I'm again going to plot an imaginary level right here. Let's say this level is sitting at 50 rupees and the price starts going down from 100. For some reason, price taps into this 50 rupee wall right here and it bounces back up. Not down, it bounces back up. Taps, bounces back, taps, bounces back, taps, bounces back. Correct? Price started from where? It started from 100. Now, guys, would you agree if I say that the market is supporting the price from falling any further than 50? Would you agree? The market is supporting the price from falling any further than 50 and it's pushing the price back up. Pushing the price back up, right? It's acting, this wall is acting as a support, right? The price is being supported. It's not letting the price fall below 50. And that is exactly the reason why this level right here is called your support level. Now, my question to you is, if resistance level is caused by buying, support level is sorry, if support level is caused by, sorry, resistance level is caused by selling, support level is caused by what? Support levels are caused by buying, exactly, right? So someone is sitting at 50 rupees and buying, right? We don't know who is responsible for doing that yet. We just know that some buying is happening every time price reaches 50. That's all we know. And that's the reason it forms a support level. Correct? Till here it is clear. But the problem here is in these examples that I've given you, I have drawn support and resistance levels horizontally, right? It's horizontal. I've drawn horizontal support and resistance levels. Correct? It's like support, resistance, support, right? I've drawn horizontal levels. But the fact of the matter is, your support and resistance levels does not have to be horizontal. It can be slanted like that, right? Which means your market can take resistance like that as well. It can take resistance like that. Market can take resistance like that. Market can take resistance like that. Now, this resistance is not called a resistance level. This right here, just because it's slanted, it's called a resistance trend line, not a level. It's called a resistance trend line. Now, why is it called a trend line? Because if you look at this, right, if you have a slanted level, if you have a slanted resistance or support, you kind of understand the trend in which the market is trying to head towards, right? Because if I'm looking at here, I know for a fact that, okay, this is uptrending, right? I understand the trend. And that is the reason why your slanted support and resistance are called trend lines and not levels, right? Now, quick question. If this right here is your resistance trend line, then guys, what is this? What is that? If that right there is your resistance trend line, then what is this? What did I just plot right now? Is that a support level or is that a support trend line? Exactly that. This right here is a support trend line. It's not a level. Levels are horizontal. Don't forget. Right? Now, now I'm going to show you examples. Let's move back. Guys, what did I just plot right now? What is that? What did I just plot right now? What is that? What level? What level? Be specific. Is that a resistance level? Is that a support level? What is that? That's a resistance level. Good. Right? Now, what about this right here? What about this right here? What is that? What is that? What did I just plot right now? That's a this right here is what? That is a resistance trend line. Why? Because it's at the top. Right? If that is a resistance trend line, then what is this? Then what is that? If that's a resistance trend line, then this is what? That's a perfect. That's a support trend line. Correct? Perfect. Right? So what are you essentially doing here? You are basically connecting the dots. Is that understood? You are basically connecting the dots. Now, what is that? What did I just plot right now? What did I just plot right now? That's a resistance trend line. Why? Because that's at the top and not at the bottom. Correct? Now, we shall continue. Let's see. What about this right here? What is that? What is that? What did I just plot? What is that? Perfect. That is a support trend line. Correct? Now, what about this right here? What is that? What is that? Perfect. That is a resistance level, which basically means right here, what is the price you check? 24,143. Someone is constantly selling at 24,143. Correct? Now, I hope this is clear. Guys, please type yes if you will be able to plot your levels and trend lines by yourself in the chart moving forward. Would you say it's very simple, very easy, right? What are you doing? You're just drawing, right? You're just connecting the dots. Whenever you see market create some sort of slanted, which we can connect, boom, there you go. That's a trend line. Finished. As simple as that. You can extend it, boom. Again, it's respecting this entire trend line. Correct? Very easy. Perfect. Can I move forward or do you all need more examples? Can I move forward or do you all need more examples? Go ahead. I can move. Perfect. Awesome. Now, now I am going to introduce you all to something else, right? A very easy concept called breakouts. What are breakouts? Very simple, right? I'm gonna plot an imaginary level. I'm not gonna call it imaginary level anymore. You'll understand what's happening. I'm gonna plot a resistance level. And let's say market is doing this. Let's say the market is doing this, doing that, doing that. This is something that we call a volatility contraction. But let's say market does that. A breakout is the process of market breaking out of your resistance level. What's a breakout? Breakout is the process of market breaking out of your resistance level, resistance or a support level. Both are breakouts. Correct? Now, this is called a resistance breakout. Why? Because the price is breaking out of a resistance level. Correct? Now, similarly, we can have support breakouts as well. Right? I'm going to plot a support level. So, if market is contracting, contracting, and boom, what is that? That right there is a support breakout. What is that? This right here is a support breakout. Understood? Now, if there can be level breakouts, if there can be level, resistance level and support level breakouts, there can be trend line breakouts as well. Correct? So if I am plotting a trend line like that, market can do what? Market can respect the trend line and then boom, break through the trend line. This is what? What is this called? So we have level breakouts and then what is this? If the ones that I've plotted previously are level breakouts, what are these called? Exactly, these are called trend line breakouts. These are called what? These are called trend line breakouts. Very simple, right? Now I'm going to show you all examples. Let's see. Can I consider that as a trend line breakout? What do you think? Yes or no? Can I consider that as a trend line breakout? So what is happening? Market is breaking through my trend line, right? That's a trend line breakout. That's a resistance trend line breakout. Correct? Similarly, can I consider that as a trend line breakout? What do you think? Can I consider that as a trend line breakout? Yes. Perfect. Perfect. Let's see. I'm going to give you examples until y'all figure it out. Can I consider that as a trendline breakout? What do you think? Very easy, right? Very easy. Looks very easy to identify these breakouts. We're going to keep doing this until y'all figure out how to do this. All right. Can I consider that as a trendline breakout? Is that a trendline breakout? Perfect. And that's all. As simple as that. Right? Now, now, right now you understand things about the stock market more than majority of people out there. But this is obviously not enough, right? There is so much more that you need to understand about stock trading, right? So much more. Now, to get started with, we have to understand, right? I mean, I'm sure everyone, at least most of you all know this. There are two market participants. We have the retail traders and investors, and then we have the institutional traders and investors. In which category do we fall in? Are we the institutions or are we the retailers? Are we the retail traders or are we the institutional traders? Correct, we are the retail traders, right? Now, who do you think is responsible? Who are the institutions, guys? Institutions are people with or institutions with huge amount of money to play around with, right? The big banks of the world, the Goldman Sachs, the Vanguards, the BlackRocks of the world, LICs of the world, right? Now, am I audible? Am I audible? Am I audible? Am I audible now? Am I audible now? Ah, okay. I don't know what happened there. Okay. Now, so let's say, see, there are some 450, 468 people right now in this webinar, right? Let's say we all create a WhatsApp group together, and let's say we all decide to buy shares of Reliance exactly at 10 a.m. Do you think if we pool all our money together, we'll be able to create a candle like this in Reliance? Do you think that's possible? What do you think? If we all pool all our money together while trading in Reliance exactly at 10 a.m., if you all place our order exactly at the same time, do you think we'll have enough money to move the market? Very unlikely, right? Unless we have a couple of crore patis in here. Sorry, my bad. Right? So I see. I'll give you a general example. Right? See, when I'm trading futures, I'm punching in orders worth of 65 lakhs in market orders. When I'm punching this order, the candle doesn't even flinch. So imagine the amount of money which is required to move the market. It's insane, right? So it should be fairly easy for us to understand that the market is completely being moved by the institutions. That being said, if institutions are moving the market, again, like I said, we have institutions, then we have retail traders. Now, it is important, it is very important for us to understand exactly how the institutions move the market, right? We need to understand how the institutions are pumping in the money, they're taking out the money, how are they accumulating, how are they distributing. Very important, right? And the retail traders, right? We also play a very, very, very significant role when it comes to stock trading and moving the market. Now, it might not be like how you're expecting it to be. It's a little different, it's a little dark, It's a little evil, but we also play a very important role in moving the price, right? So that is what we are going to be focusing on. We are going to first understand exactly what the retail traders do, and then we are going to dig deep into understanding exactly how the institutions move the market. All right. Now we're going to start off with understanding what the retail traders do. Before I get to it, I have a question. Now, this question is for all the people who have been trading. Guys, how many of you all, what is your current system? What is the current strategy that you currently use to trade? Is it price action? Is it breakouts? Is it chart patterns? Is it EMA, RSI, MACD, type, Bollinger Bands, type, price action, macro news, EMI, FA, breakout, price action, EMA, breakout, chart, ADR, SMC, price action plus pattern, price action, RSI, price action, MACD and price action, MACD breakout, RSI, MACD price action, breakout, pivot, trend line, price action, breakout. All right. So, my point being, which is proved evidently, 90% retail traders who currently trade in the stock market, they trade something known as price action. They follow something called price action trading. 90% retail traders who currently trade in the market, they use price action trading to trade. Now, since all of these people are using price action trading, it is very critical for us to understand what is price action. Correct? I'll tell you why it is relevant. Why do we care for all these 90% retail traders out there? Very important. So first, we're going to learn what price action trading is. It's a very basic, very simple system, right? So let's say I have a resistance level, and the market starts doing something like this. Again, this is called volatility contraction pattern, which is very different from trading breakouts. But let's not get into that. But let's say the market is doing something like this, something like that, and it breaks out, and we have a breakout. As per the textbook definition of price action trading, after a breakout, market is ideally supposed to continue with the direction of the breakout. So if the breakout is happening to the upside, market is ideally supposed to continue heading higher. Cool. Now, if you're a price action trader, what are you supposed to be doing? You are supposed to buy at the breakout here, or maybe some people buy here at the retest, right? You're supposed to buy at the breakout. You're supposed to buy here and wait for the market to head higher so that you can sell for profit. This is going to be your profit. This is price action trading. Can the price action traders agree with me? Is this what you do? The same case for chart patterns as well. Type. Is this what you currently look for in the market, in the charts? Yes. Perfect. Awesome. Yes. And okay. Perfect. But see, the problem, there is a very tiny problem here, right? There is a very tiny problem. It is not that big of a problem. It's a very tiny problem. The tiny problem is that 7 out of 10 times after a breakout, instead of going up, 7 out of 10 times your breakouts fail. It goes back down. Now, this can the price action traders agree? Type. 7 out of 10 times your breakouts fail. Yes, perfect. Awesome. Yes, perfect. True happens. Yes, perfect. Now, that means if you are a price action trader, you are automatically trading a system with a 30% win rate, which is very bad. Which means majority 7 out of 10 times you are losing money, because if you are buying here and let's say you keep your stop loss here, if you buy here, what happens? Your stop loss gets hit and you end up losing money. This is what happens 7 out of 10 times, right? Now, if again these are proper stats, right? I'm not pulling this number out of thin air, right? This is actual proven stats that 7 out of 10 times breakouts fail, and I'll show everything. Don't worry, right? I'm whatever I'm going to be talking about. I'm going to show all of it in chart. Now, my question to you is, If 7 out of 10 times breakouts actually fail, after a breakout, would you rather buy at the breakout or would you rather sell at the breakout? What do you think? Would you rather buy at the breakout or would you rather sell at the breakout? Because if you think about it, if you sell at the breakout, then you automatically have a 70% win rate. Correct? Because 7 out of 10 times breakouts fail. So instead of buying, if you just decide to sell, what happens? You have a 70% win rate at that point. But do you think trading is as easy as just selling at a breakout or doing reverse of a breakout? Absolutely not. Absolutely not. There is so much more to understand than just support, resistance, and breakouts. Correct. Now, either ways, right? The fact that 90% retail traders currently do this exact thing to trade, it is very critical for us to, yeah, trend is your friend, right? So see, these are some of the things that people come up with to help them calm their nerves, right? So if they lose money trading breakouts, they're gonna convince themselves that, okay, dude, the reason why I lost money is might be because of my psychology. I went against the trend, there wasn't enough volume, I should have waited for retest. They'll come up with a bunch of excuses, but again, that's generally not how the market functions, right? So it is very critical, very important for us to understand why this happens. Why does 7 out of 10 times breakouts fail? Why does that happen? Right? Very critical. Because if you don't understand what exactly is happening here, what exactly is happening here, what is happening here, why are retailers losing money? Why is what is happening 7 out of 10 times? We can't move forward, right? Because there won't be clarity on what's happening. Right? And we need clarity. We are going to be trading, right? It's a very difficult thing to do. So there should be absolute clarity. Now, to have clarity, oh, okay, by the way, I'll show you examples, right? I'm sorry. Was there a okay? So if you were a retail trader, what would you have done here at the breakout? If you were a retail trader, what would you have done here? Right here at the breakout, what would you have done? You would have done what? You would have bought or sold? You would have bought. So what ends up happening? Did you make money here or did you lose money there? What happened here? If you would have bought here, what would have happened? You would have lost money. Correct. So same goes for every. I'm not saying every 7 out of 10 times, right? Did I plot anything else? Okay. Would you if you would you have bought here at the breakout? What would have happened if you would have bought here at the breakout? At this 10 line breakout? What happens? You buy here, boom, finished. Correct? What happens here? What happens here at the breakout? You buy the breakout, you look at the candles, boom, goes back down. See, there is something else that people, retail traders, I've seen, use, right? Which is their volume. People look at the volume, and this is important for breakout traders for some reason. You look at the volume. Apparently, as per the textbook definition of price action trading, you need an increase in volume at the area of breakout, which should be there because otherwise it's not a confirmation, apparently, right? But if you see here, what do we have here? Do we have an increase in volume? Do I have an increase in volume at the breakout? Exactly at the breakout, do I have an increase in volume? Yes, I do. Which means what? Which means I should buy as per the theory, right? But what ends up happening? You buy here, boom, goes back down, you lose your money there. Correct? So your volume that you see here at the bottom, this is what? Wait. This is useless. So you are going to remove the volume. You are going to be trading based on the naked charts. You are not going to be using any indicators, no super trend, no EMA crossovers, no RSI, no MACD, nothing. Right? You are going to trade and understand and read the naked charts. VWAP, no, nothing. I want you all to understand how to trade the naked charts, right? Now, I don't want your bro. See, I've seen charts where you have multiple indicators right there, right here. There will be cloud here, there will be MACD here at the bottom, bunch of 3, 4, 5 indicators there, super trend here, giving up down signals. Bro, do you see what's happening? Are you able to read what's happening between all these charts and all these lines and moving averages? No. What is this? Is trash. This is not how you trade. Yes, old days becoming Picasso. Exactly, right? That's not what you do. That's not how you trade. So again, what are we going to do? We are going to understand why 7 out of 10 times breakouts fail to start off with. Cool. Now, to learn that, I am going to introduce y'all to something called liquidity. Guys, what is liquidity? Type. I need you all to tell me what you think liquidity is. I'm sure you've heard of that term before. What do you think is liquidity? Cash, money, all right? Fuel, all right? Stop losses waiting? Not really. Doesn't have to be stop losses. Pending orders, right? I had heard but not no idea. Pending order, fuel, pumping money, limit orders, all right? Fuel, all right? Supply, buyers, sellers, all right? Orders, orders, free cash, all right? Money laying in the market, flow of cash, orders. Now, to put it in very simple terms, liquidity is nothing but pending orders in the market. What is liquidity? Liquidity is nothing but pending orders in the market. What do I mean by that? What do I mean when I say liquidity is nothing but pending orders in the market? What do I mean? Let's try to understand. Boom. So let's say this right here is the chart of Tata Motors, right? This right here is the chart of Tata Motors. Tata Motors is doing something like that. Now I am watching. So let's say this is Monday, right? Now it's Monday. I'm watching the chart of Tata Motors, and I'm looking at the chart, and let's say currently the price of Tata Motors is sitting at 100. Right? When I'm opening the chart of Tata Motors, currently the current price, the last traded price of Tata Motors is 100. Now I'm watching the chart in my broker app or my charting platform or trading view or whatever. Now I'm looking at the chart and I'm doing my whatever analysis, right? And I figure out, for some reason, I figure out that the price of Tata Motors is going to reach up to 200 after my analysis. So what will I do? I will buy shares of Tata Motors, right? So what will I do? I'll open Zerodha or Fires or Upstocks or Grow or whatever broker I use, and I'll click on Tata Motors and I'll place a buy order. Let's say I want to buy 50 quantities. I want to buy 50 shares of Tata Motors, right? I place a buy order for 50 shares of Tata Motors at 100. Now, guys, would you agree if I say that for every buyer there has to be a seller, and for every seller there has to be a buyer? Would you agree? No, someone said no. Why do you? Okay, I'm gonna give you an example. Let's say I can't believe I'm breaking this down, but okay, let's say that I have a buyer, I have a seller, right? And this right here is a fruit store. That's a fruit store, correct? And let's say the buyer goes to the fruit store, seller is already there in the fruit store. Let's say the buyer wants to buy 100 apples, and the seller, let's say the seller only has 10 apples to sell. Even though the buyer wants to buy 100 apples, how many apples can the buyer actually buy? Even though the buyer has enough money to buy 100 apples, how many apples can the buyer buy? He can only buy 10. Why? Because the seller is only selling 10 apples. Correct. Same thing if you take an ulta. Let's say the buyer wants to buy 10 apples, but the seller, for some reason, he has to sell 100 apples. Even though the seller wants to sell 100 apples, how many apples can the seller sell? Only 10. Why? Because the buyer only wants to buy 10 apples. Correct. So it would be very logical that for every buyer there has to be a seller, and for every seller there has to be a buyer. Cool. Please keep that in mind. Now, guys, if that is the case, if I'm placing a buy order for 50 shares of Tata Motors at 100, what is my requirement? What do I need? If I'm placing a buy order for 50 shares of Tata Motors at 100, what is my requirement for my order to go through? I need a seller. I need a seller who's ready to sell 50 shares of Tata Motors at 100. Now, if this seller was not there in the market, will my buy order be executed? Absolutely not. Correct? So, my question, have you ever, I'm sure at least some of you all have some time in your life ever for trading or investing, have some time, I mean, at one point in your life, you've placed an order before, right? So, when you place a buy order and when you click the buy button, your order is executed instantly. That second, the second you press the buy button, your order is executed. Does the broker ever give you a message saying, boss, please wait while I find you a buyer, please wait for 5 minutes, let me see if I have a seller who is ready to sell 50 shares for you, and then I'll place your order? No. Does that ever happen? No. If you're placing market order, your order will get immediately executed. Just a second, you can start seeing your profit and loss, right? You are already in the trade. So, my question is, even though you place the buy order, you already know for a fact that for your buy order to go through, you need a seller. So, how did the market find this seller? Where did this seller magically come from when you place that buy order? Is my question. Where did the seller magically appear out of nowhere? What? How did that happen? Anyone? How was the market suddenly able to find you seller? The moment you press the buy button, where is the seller coming from to place your order? How does that happen? Broker bot? No, broker is not doing anything like that. Smart money in circuit, collection of small sellers. Someone is already sitting there, accumulation because of data internet, not so because of exchange. No? All right. We'll continue with the example. Don't worry. We'll figure it out. So I have successfully placed my order. What is my order? I placed a buy order for 50 shares of 100 and it got executed. Why did it get executed? Because I was able to find sellers. Let's say the market again hits higher. After I buy, let's say the price reaches 150. Right now the price is at 150. Now once the price reached 150, I am again interested because my target is 200 rupees, right? Because that means I have another 50 rupees movement which is left. So what will I do? Right now I want to buy more quantities. So let's say I place another buy order. This time I want to buy 100 quantities, let's assume. So I place a buy order for 100 quantities at 150. Guys, for this order to go through, what is my requirement? For my buy order to go through, for my buy order to get executed, what is my requirement? Exactly, seller. What seller? I need a seller who is ready to sell 100 quantities of Tata Motors at 150. Correct? And for some reason, even this seller I was able to instantly find. Why do I say that? Because the moment I press the buy button, I am automatically in the trade, which basically means that instantly I was able to buy the seller. I mean, I was instantly able to find this seller who is ready to sell 100 shares at 150. Now, regardless of what price you are buying, regardless of how many quantities you are buying, you are always provided with the sellers that is required. Now, where are these sellers coming from? Now, what I want you to understand is that the market is filled. It's filled with a bunch of imaginary pending sell orders just sitting there waiting to be executed at all the price points. There are a bunch of sell orders sitting there pending, right? These are pending orders just sitting there waiting to be executed, right? For example, let's say let's say I did not place this order. All right, while the price was at 100, let's say I did not place this order. But even though I did not place that order, this order right here, this sell order for 50 shares at 100, it is already there in the market. But this order is a pending order. This is not an executed order yet. This order is a pending order. When will this pending order be executed? When I place this buy button. When I place this buy order. When I place this buy order, when I click that buy button, what happens? This pending order will now get executed. Is that understood? Is that understood? Very clear? Now, similarly, here also, if I had, before I had placed this buy order, before I had placed this buy order, this sell order, a sell order for 100 shares at 150 was already sitting there at that price point. Now, that order, is that a pending order or is that an executed order? Right now, this order, is that a pending order or is that an existing, is that an executed order? It's a pending order, right? It's a pending order. What happens? Now I come to the picture and now I will place a buy order for 100 shares at 150 and I click the buy button. When I click the buy button, what happens? This pending order, which was already existing in the market, this order will now become executed due to my buy order. Correct? Till here, I hope it is clear. Till here, I hope it is clear. Don't worry, I'll make everything clear. Let's move forward. So this happens, right? I place an order for 50 shares at 100. I place another order for 100 shares at 150. Let's continue. The market again heads higher. It again heads higher. What happens? It reaches my target. What is my target? My target is 200. My target is 200. And it reaches 200. So once it reaches my target, what do I want? I want to sell everything for profit. So how many shares do I own currently? I bought 50 here, I bought 100 here, which means I have a total of 150 shares. So I want to sell 150 shares of Tata Motors at 200. Now guys, for me to sell 150 shares of Tata Motors at 200, what is my requirement? What is my requirement? Exactly, I need a buyer, correct? I need a buyer who is ready to buy 150 shares of Tata Motors at 200. Correct? Now, obviously, when you sell, when you click the sell button, does the broker ever give you an error message saying, boss, you can't sell, you can't book your profit right now. Please wait until I find you a buyer. Does that happen? No. Even selling happens instantly, right? You are instantly being provided with the buyer. So that means the market is just not filled with pending sell orders, it's also filled with a bunch of buy orders as well. The market is also filled with a bunch of buy orders as well. Now, these existence of pending buy and sell orders in the market is called liquidity. Type yes if you understand exactly what liquidity means. Understood? Very clear? Very clear? Perfect. Now I'll give you one last example to make sure you completely understand the concept. Now, have you heard of, now obviously, right? All these pending orders are created by who? Institutions or retailers? Who do you think is creating these pending orders? Who do you think is creating liquidity? Obviously, the institutions. Because do we have enough orders to create that much liquidity? Absolutely not. Institutions are just sitting there creating this liquidity. Correct? Now, I'm going to give you a very tiny example. Have you heard of penny stocks before? Stocks which are trading at 2 rupees, 1 rupee, right? Stocks that no one cares about, right? These are called penny stocks, right? There is no liquidity there, right? These are called illiquid instruments, right? Illiquid stocks, your penny stocks. For I'll give you an example, right? Let's say this right here is some random penny stock, which is currently trading at 2 rupees, which is currently trading at 2 rupees. Now I'm watching this penny stock and I'm like, okay, dude, I want to buy into this penny stock. So what will I do? I'll place a buy order. Since at 2 rupees, let's say I want to buy 10,000 quantities at 2 rupees. Now in this scenario, if I press the buy button, will I immediately be able to find seller here? What do you think? Will there be sellers readily available there? No. Which means this buy order will not go through. Why? Because for my buy order to go through, what do I need? I need a seller who is ready to sell. I need seller's liquidity. I need seller's liquidity. How much liquidity do I need? I need 10,000 worth of liquidity at 2 rupees. But in penny stocks, there is no liquidity. It's very illiquid. So only thing I can do here is I myself can place a pending order. I myself can place a pending order hoping that I find some seller who is ready to place this order. So if someone sees this pending order, if some seller sees this pending order and he's like, okay, dude, I see this pending order, I'm ready to sell it to you. If that happens, then this buy order will get executed. Until then, it won't be executed. Why? Because there is simply not enough liquidity in penny stocks. Now, this is very different from all the normal stocks that you currently trade because all these stocks are very much liquid. Everywhere you can trade at whatever price, how much ever quantities without, worrying about there not being orders to fill you, right? That won't happen. Cool. I hope you understand exactly what liquidity is. Correct? Now, now, what have we established so far? We have established that the entire market is filled with liquidity, right? The entire market is filled with a bunch of pending orders. Now, here is where things get interesting. In some certain areas of the market, there will be much more pending orders compared to other areas of the market. Don't worry, I'll explain. In some areas of the market, there will be much more liquidity, much more pending orders compared to other areas of the market. In some areas of the market, there will be much more liquidity compared to other areas of the market. And here is where I'm going to introduce y'all to the rule number one of price behavior. Rule number one of price behavior states that the market always moves in search of liquidity. Guys, this is extremely important. This is going to be your bread and butter moving forward. Please take a screenshot, type done once you're done taking the screenshot. Market always moves in search of liquidity. Done? Type done. I need 436 yeses. Type. Sorry, done's. My bad. Type, 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 type. Done? All right. So let's try to understand what rule number one actually means, right? What does it say? It says that the market always moves in search of liquidity. Correct? Which means which means let's say the market starts from here and it absorbs all the liquidity here. Where do you think the market is likely to head towards? Will it go up or will it go down? What do you think? Exactly, it'll go down, absorb all this liquidity. Now, will it go up or will it go down? Exactly, it'll go down, absorb all this liquidity, go up, absorb all this liquidity, it'll go up, absorb all this liquidity. Now, the obvious question that everyone would be having is how do we identify these pools of liquidity, right? Because if you're able to understand where these pools of liquidity are present, then we kind of understand the direction in which the market is trying to head towards. Correct? Because market moves in search of liquidity. So if you're able to understand where these areas of these pools of liquidity is present, then we know that okay, market is likely to go there and absorb that liquidity. Correct? Now, if this much is clear, let us go back to our understanding of price action trading. Cool. Now, I'm gonna plot a resistance level. Let's say I'm a retail trader who trades price action, and then I see the market do this. I see the market do this. and then a breakout happens. Would you agree if I say that me, along with a bunch of retail traders, would have bought here at the breakout? Would you agree? Thinking that market's going to continue heading higher, right? So let's say right here at the breakout, 100,000 buyers came in exactly at the breakout, right? Now, obviously, right, if you're a trader, if you're buying somewhere, if you're buying into a trade, you are going to be keeping your stop loss. And majority of the people would be keeping their stop loss where? Right below the swing, right? So if 100,000 people entered the trade here, it means that 100,000 people would have kept their stop loss right here. Okay, so let's look at what is actually happening. Let's pretend this is the live market. So market is doing this. I see a breakout happening. Right now the market has just created a breakout. So what will I do? I'll place a buy order. Right as soon as I place the buy order, what will I do? I'll place a stop loss order right here. I'll put a stop loss here to make sure I get stopped out in case the market does this. Right? I put a stop loss order. Correct? Right now the market is here. Now, guys, this stop loss order, which I have put after entering the trade here, currently, while the market is above the resistance level, is it a pending order or is there an executed order? Right now, in its current situation, is there a pending order or is there an executed order? That's a pending order. Why? Because it's not executed yet. I have only placed the stop loss. It is not executed. It will only get executed when market comes back here. Correct? So, if you think about that, if 100,000 people came in here, that is a lot of liquidity, which that possibly means that 100,000 stop loss orders would be sitting here in the form of pending order. Would you agree? If 100,000 people came in at the breakout, 100,000 stop loss will also be there. Now, 100,000 stop loss order. What are stop loss order? Pending orders. What are pending order? Liquidity. Which means after the breakout, where do you think the market is likely to head towards? Up or down? Up or down? Exactly. Market will do what? Market will come back down to absorb all these stop loss order liquidity right here. So the people who would have bought at the breakout, did they make money or did they lose money here? They absolutely lost money. Why? Because they're all keeping stop loss at very, very evident areas, and market is going to absorb that stop loss liquidity. Why? Because rule number one of market of price behavior, market always moves in search of liquidity. So now you kind of understand the reason why 7 out of 10 breakouts fail, but you still do not have enough clarity, right? You understand one of the reasons why 7 out of 10 times breakouts fail, but there still lacks a lot of clarity on why breakouts are being formed, why it's actually coming back down, who is actually selling here. There are a lot of things that are still missing, right? The only thing you understand, I hope you understand, is that market after a breakout, a lot of people, retail traders would be entering at the breakout. And if a lot of retail traders are entering, a lot of stop loss would be there. Lot of stop loss means lot of liquidity. Market moves in search of liquidity. Boom, liquidity absorbed. Guys, till here, the concept of fake breakout, if this is understood, type yes, and we shall move forward to the next concept. Awesome. Y'all are fast learners. Nice. Now, now, again, we still lack clarity. We still do not necessarily understand what exactly is happening. Right? We are a little, it's a little shaky, these concepts. I'm a good teacher. Hey, thank you so much, Nick. So, keep whatever I've told you explained right now, keep that in mind. Keep that in mind. Don't forget. All right. Why 7 out of 10 breakouts fail? Rule number one of price behavior. Keep that in mind. So, see, Let's say I'm an institution. Guys, who's the biggest institution of India? Does anyone know? Who's the biggest institution of India? LIC, right? So for a minute, let's assume I'm LIC. Now, guys, if we retail traders have to trade, we open our broker, we go to Zerodha, we go to Upstocks, we click on the stock, we click how much our quantities, and we'll click the buy button. If I am LIC, am I also going to go on Zerodha or Upstocks and place a buy order for 10000000000 quantities and then click the buy button? Is this how I'm going to trade as an institution? Absolutely not. So, how do I trade? As an institution, how do you think I trade? Anyone? Do you think I'll have a bunch of um, you know investors or fund managers under me? I'm gonna hire one Raju who has a bunch of traders below him, and I'm gonna give 100 CR to Raju. Raju is going to split that into all these people, and all these people are going to be buying, selling, buying, selling, buying, selling at every single price points every single second. Do you think that makes a little bit more sense? But that is also not what's happening. So, how does institutions actually place orders? How do they move the market? And how do they do it every single second? See, institutions use something called the high frequency trading algorithm. Institutions use something called the high frequency trading algorithm. What is a high frequency trading algorithm? This algorithm is responsible for placing. So let's say I'm an institution, right? Let's say I want to buy 100 crore worth of shares in Tata Motors. So I am going to instruct my algorithm to buy 100 CR worth of shares in Tata Motors between maybe 100 and 110. This is the instruction which I'm going to be giving this algorithm. So what happens? This algorithm is responsible for making sure this entire 100 crore is bought in the form of shares. So this algorithm will they'll keep placing orders at a high frequency. They'll buy. Every single second, it's gonna keep executing orders in a high frequency. That's why it's called a high frequency trading algorithm. So what is essentially happening? What is the instruction that I've given? I want to buy 100 CR worth of shares in Tata Motors at a price window of at a price window between 100 and 110. I want 100 crores to be traded. When that happens, every time the price of Tata Motors comes between 100 and 110, what gets activated? My algorithm gets activated. And what will the algorithm do? As long as the price stays between 100 and 110, it'll keep buying. It'll keep buying, 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 it'll keep buying. Let's say this price is 110. Let's say the price moves above 110. Will the algorithm keep buying? No, it'll stop. Why? Because this is not the instruction which it was given. So, long story short, what is happening? The algorithm will be given an instruction. Now, this trading algorithm, which is obviously be built by a bunch of extremely smart people, I would assume, that algorithm is responsible for placing all these orders in the market, regardless of what instrument you're trading. This is the same. Every single institution out there uses a high frequency algorithm to trade. Right? Now, the exact algorithm, obviously, it's going to be different in different institutions, but the key idea is exactly the same. Right? Now, keep that in mind. So, what do we know so far? That institutions use high frequency trading algorithm to trade. Got it? That's all that I want you to understand for the time being. Right? Now, I am going to introduce you all to something called liquidity engineering or price inducements, or to put it in very simple terms, manipulations. Now, have you heard of any of these terms before? Type liquidity engineering, price inducement, Manipulations, I feel like you should have heard, right? Manipulations, I've stock market manipulation. Harshad Mehta manipulating the stocks, right? Inflating the prices. Yes. Now, what is liquidity engineering? What is price inducement? What is manipulation? This is very interesting, very dark, very evil, but this is something that happens every single minute. This is very dark that this happens, very evil that this happens. Let's try to understand what this is. Let's say I am LIC, and this right here is the chart of Tata Motors. This right here is currently the chart of Tata Motors. Now, I am an institution, I am LIC, and my trading plan is to sell 100,000 shares. What do I have to do? I need to sell 100,000 shares of Tata Motors. Guys, for me to sell 100,000 shares of Tata Motors, what is my requirement? How many buyers do I need? For me to sell 100,000 shares of Tata Motors, how many buyers do I need? What is my requirement? Exactly, I need 100,000 buyers. Correct. But let's say I need 100,000 buyers liquidity. Correct. But let's say right here, I have 1.5k buyers, I have 2k buyers here, I have 1k buyers liquidity here, another 2k buyers liquidity here, another 1.5k buyers liquidity here, 2k buyers liquidity here, 3k buyers liquidity here, another 1k buyers liquidity here, 5k buyers liquidity here. Guys, do I have enough buyers liquidity to place my order? Do I have in this chart of Tata Motors currently, do I have enough buyers liquidity to place this huge order? I don't. So, what will I do at this point? I am going to do something called liquidity engineering. I'm going to engineer liquidity. How am I going to do that? I am going to instruct my algorithm to do something. So, when I instruct the algorithm to do something, this is what's going to happen, right? The market will go up, market will do that, market will do this, market will do this, market will do this, market will do this, it'll do this, it'll do this, it'll do this, and it'll do this. Are we familiar with this pattern? What is happening here? What is currently happening here? What is happening here? It's a breakout. Now, if I was a retail trader along with a lot of others, if I see this happening in Tata Motors, will a lot of people buy at the breakout? Yes or no? Will a lot of people buy the breakout thinking that okay, chart of Tata Motors is finally trying to head higher, right? A lot of buyers will buy right here at the breakout. Guys, now do I have enough liquidity to place my sell order? Now do I have enough liquidity to place my sell order? So when all these retail traders are buying at the breakout, who do you think is selling it to them? Who do you think is selling it to them when all the retail traders are buying at the breakout? LIC, right? The institutions. Now you already understand what's happening after this, right? If you're entering at the breakout, a lot of people would be keeping the stop losses here, and what eventually ends up happening, market goes back down. Now, who made money here? The retailer or the institution? It's always the institution. So what I needed to understand is that the market or the institutions are constantly manipulating retail traders into providing them with the liquidity that they need to trade. Retail traders are constantly manipulated to just be liquidity for the institutions. As a matter of fact, do you know what retail traders are called by the institutions? Does anyone know what we are called by the institutions? The nickname that was given to us by the institutions? We are called dumb money. We retail traders are called dumb money. And you know why that happens? Because we fall prey to very nasty tricks like this. Institution has basically printed a fake pattern, induced a fake breakout just so that dumb retail traders will buy here and provide the provide the institutions with the liquidity that they need. We are the dumb money and institutions are the smart money. And you know the best part, what are we going to learn today? We are going to learn smart money concepts. Cool. So we are going to understand what the institutions are doing. Now, guys, type yes if you understand exactly what liquidity engineering is. Is this concept very clear for everyone? Do you all understand how the retail traders are manipulated by the institutions? Is this clear? And now you do you understand the reason why you should not be trading breakouts? Perfect. Now you understand the reason why 7 out of 10 breakouts fail, because these breakouts are majority of the times induced by the institutions, right? These are just made, these are created. It's created. Why? To engineer liquidity. Who's the liquidity that they're engineering? We, us, the dumb money. We are the liquidity. Correct? So, I hope this is clear. Now, that being said, I am going to give you all a few general assumptions that you will be making moving forward. What are the general assumptions? Number one, the next time when you see the market create equal highs or resistance, if you want to call it that, next time when the market breaks an equal high, what is going to be your general assumption? That it will reverse. This is general assumption one in the case of equal highs or resistance levels, if you want to call it that, right? Similarly, what is the second general assumption? If you have equal lows, if the market creates an equal low breakout or a support breakout, what is going to be your general assumption? That it will reverse. If equal high and equal low general assumptions can be made, we can make more general assumptions. For example, if I have a trend line and the market is respecting my trend line, can that be a general assumption? Can I consider that as a general assumption? Yes or no? What do you think? Can that be a general assumption moving forward? Perfect. Awesome. Now, for the people who understand chart patterns, right? I haven't taught you chart patterns because it's not important at all. But sometimes market does this, right? Market creates some triangle or whatever pattern this is called. Sometimes market creates patterns. Sometimes market creates patterns. So our general assumption would be, if market breaks through your chart pattern, it'll do this. Again, another general assumption. Tenants, all right, whatever you want to call it, right? So from this moment onwards, every time price starts breaking through an area of resistance or support, next time when you see the market do this, next time when you see the market do this, are you going to buy here at the breakout? Because what is waiting to happen? The move down. This is just market absorbing the buyer's liquidity, right? So next time when the market does this, are you going to buy at the breakout? Absolutely not. Correct? Similarly, Next time when you see the market break through, see, this is the market open, right? This is 9:15, right? This is the market open. Some people see that, okay, dude, market is opening by breaking through a trend line, so I have to buy here. What is happening? Market is going up. It went up till here, and then it got pushed back down. Boom, absorbed all the buyers' liquidity here. Boom, push back down. Correct. Similarly, what is the next general assumption that you'll be making? Next time when you see the market do this, next time when you see the market create a breakout, even though you have volume, let's see if I have volume confirmation. See, dude, I have a big volume confirmation. See, this is all fake. This is induced volume. You cannot judge the strength of the market by looking at the volume here. This is fake. This is induced volume. This is price inducement. This is not a confirmation for you to know that, okay, dude, market's kindly, it's gonna, continue heading higher. This volume doesn't matter at all. Same goes for market depth. I've seen people see, no, I'll get to market depth in a bit. But what eventually ends up happening, it goes down, right? So if when retail traders are buying here, who is selling? When retail traders are buying at the breakout, who is selling there? Institutions, correct? LICs of the world. Right now, the same goes for market depth. Now, I want you all to be very honest. This question is only for the traders. Don't worry. If you all don't understand it, don't worry. Have you all ever seen the market depth and looked at the bid and ask quantities, and have you seen a bunch of orders at the buy side, a little bit of orders at the sell side, and convince yourself that, okay, market's gonna head higher? Be very honest. Have you done that by looking at the market depth? That is very, 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 very stupid. All right, these are just limit orders. I can create this market depth. I can do it. I can create market depth. You can create market depth. These are just unfilled limit orders which can be easily manipulated. Same goes for open interest. Open interest is also very highly manipulated. Anyone can create open interest. Anyone, any big institution can create open interest. This is not a big thing to do, right? So, having said that, what are the general assumption? What have we learned so far? That we understand what is liquidity. Okay, before we get to it, liquidity, support and resistance, breakouts, price action, liquidity, engineering, price inducement, general assumptions. If all these concepts are very clear to everyone, please type yes and we shall move forward. Type, 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 type. Awesome. Perfect. Perfect. Guys, am I going too fast? Is it too much information overload? Do you all need a break? Do you all need a break? No, right? Because I have only time till 9:30. I have basically 1 more hour. And there is so much for me to cover in the next 1 hour. Can I is it cool? Do you all need a break? Oh? You all need a break? No break needed. Okay. So just let me know when you feel like this is too much information. Right? Just let me know. I'm going to give you a break. All right. Or guys, is it fine if I extend the class till maybe 10 or maybe 10:30? Do you all think you can sit and listen to me for the next I mean for an entirety of 3 hours? Do you think that's possible for you all? Oh shit, bro. I'm so glad y'all are passionate. I'm so glad. Done. Then no worries. I'm gonna give you. Can I cover one more concept before I give you a break? Can I cover one more concept? Perfect. Awesome. Now, see. So we know that institutions use high frequency trading algorithm. Correct. Now, see, there are there is something called price delivery. What is price delivery? Price delivery means how the price moves from one point to the next point, right? How it goes from how the price is getting delivered by the institution from point A to B, B to C, C to D, D to E, E to F, F to G, right? How the price is delivered from one point to next point, next point to next point, next point to next point, right? How is the price delivered? This is called price delivery. All right. Now, who is delivering the price? Obviously, it's the institutions. And what is delivering the price? The algorithm. Correct? Till here, I hope this is clear. I hope it's understood. Now, guys, there are two ways in which the price is delivered in the market. There are two ways in which the price is delivered in the market. We have balanced or efficient price delivery, and then we have imbalance or inefficient price delivery, right? There are two ways in which the price is delivered. There is balanced or efficient price delivery, and then we have imbalance. It's also called inefficient price delivery. Okay. Now I'm gonna plot both balanced and imbalanced price delivery until you're able to figure out the difference between both. Okay. Now let's see here. Okay. If I tell you that this move up that you see right here, if I tell you that this right here is balanced price delivery, but this right here is imbalance in price delivery, are you able to understand the difference? This is balanced delivery, this is imbalance in price delivery. Are you able to understand the difference? Yes. Now, if I tell you that this right here is balanced price delivery, but this right here is imbalance in price delivery, are you able to understand the difference? Perfect. If I tell you, I'm gonna keep doing this until you figure this out, right? If I tell you that this right here is balanced price delivery and this right here is imbalance in price delivery, are you able to understand the difference? This is imbalance, this is imbalance, this is balanced, this is balanced, this is imbalance, this is balanced, this is balanced, imbalanced, imbalanced, balanced, imbalanced. What is the difference that you're seeing here? See, if you've noticed, right, these my imbalanced price delivery is where I'm having big candles. Big candles are what I'm calling as an imbalanced price delivery. Now, if you see here, this right here is a balanced price delivery, and this right here is an imbalance in price delivery. What is the difference? In a balanced price delivery, you are seeing overlapping candles. You are seeing candles overlap each other, and in an imbalanced move, you see big candles which doesn't necessarily overlap each other. Correct? So that right there is an imbalance move. My question to you is, let me ask you this, guys. Can I consider this as an imbalanced candle? Yes or no? Perfect. Now, can I consider this as an imbalanced candle? Can I consider that as an imbalanced candle? No, I can't. Right? So I hope you understand the difference. Now, I'm going to give you two scenarios. In scenario number one, let me change the color, make it green and give it a border. All right. In scenario number one, price is going from 100 all the way till all the way till 120. I have an imbalance candle here. This is scenario number one. Now in scenario, so what is happening? Price quickly went from 100 all the way to 120 in scenario number one. In scenario number two, I have an imbalanced move. I have a candle here. I have a candle here. I have another candle here. I have another candle here. And then I have another candle right here. I'm going to draw a few wicks. Wicks there. Wick here. Wick here. And a wick there. Here also what's happening? The price is going from 100 all the way till 120. This is scenario number 2. Guys, in which scenario would you say the price between 100 and 120 was traded properly? Scenario number 1 or scenario number 2? In which scenario is the price between 100 and 120 traded properly? 1 or 2? Everyone is saying 2, but why do you say that? Why do you think the price between 100 and 120 is not traded properly in scenario number 1? Why do you say that? Anyone? Why do you say that the price between 100 and 120 is not traded properly in scenario number 1? Why do you say that? I need a good answer. Only by liquidity? No. Not overlapping pending orders, quickly went up, manipulation, time frame, buying pressure. Okay, see, let's try to understand what's happening, right? Let's look at my. I'm going to draw an imbalance candle. I'm going to draw an imbalance candle, right? So the price is going from 100 all the way till 120. Okay. Now, let's say I'm LIC and I want to buy 100,000 shares of Tata Motors. Now, currently the price is at 100. Okay. While the price was at 100, I placed a buy order for 100,000 shares of Tata Motors. Guys, for me to buy 100,000 shares of Tata Motors, what is my requirement? I need 100,000 sellers. So, guys, how does the candle move? Initially, I place my order at 100. While the price was at 100, I press the buy button, right? I'm an institution. I place my order for 100,000 shares at 100. The candle will keep going up until it finds 100,000 sellers, right? So the candle starts going up. No 100,000 sellers here, no sellers here, no sellers here, no sellers here, no sellers here. For some reason, the candle closed at 120. Why do you think that is? Why did the candle close at 120? Why did the candle close at 120? Because 100,000 sellers were available only at 120. For example, let's say 100,000 sellers were present at 110. Where will the candle close? At 110 or 120? The candle would have closed here. Correct. So the fact that at 100, even though the order got placed at 100, what is the candle doing? Candle is constant. The price is constantly searching for 100,000 sellers. No sellers, no sellers, no sellers for so the fact that the candle closed at 120 means that 100,000 sellers were only present at 120 and nowhere in between. So my question is, guys, here in this scenario, was there liquidity between 100 and 120? Yes or no? Was there liquidity between 100 and 120? No. Right? Because if at all there was enough liquidity, the candle would have closed. The fact that it created a big candle means that the liquidity is only present right here at 120. Cool. So that basically means that I was not able to trade, me an institution, right? I was not able to place my orders between 100 and 120, which means this entire area was inefficiently traded. This entire area was inefficiently traded. I was not able to efficiently trade between 100 and 120. Why? Due to the lack of liquidity. I was, even though I placed my order at 100, my order got executed at 120 and nowhere in between. Which means was I able to efficiently trade? Was I able to buy at 101, 102, 103, 104, 105? Was I able to do that? Was, as an institution, was I able to buy 1 lakh here, 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 1 lakh here? No, I was only able to buy 1 lakh at 120 because sellers were only sitting at 120, nowhere in between. So this right here is an area of inefficiency. Keep that in mind. This right here is an area of inefficiency. Let's go back to scenario number 2. What is happening here? I place my order. Let's say this price point here is 104. Let's say this price, that high right here is 104. So initially I'm placing my, initially the price is at 100. I place my order at 100. What happens? The candle goes up, goes up, goes up, goes up, and it stops here. What does that mean? It means that 100,000 sellers were present at 104. Correct? If that means there was enough liquidity for me to place the order, my candle stopped here. Means this trading, the entire 100,000 was traded. It finished. It's traded. It's done. I found enough liquidity, which means in this one candle I was able to buy 100,000 shares. And then the second candle opens. I place another order for another 1 lakh 1 lakh shares. So that also, what happens? The candle opens and it closes here, which means another 1 lakh orders got traded right here in this candle. So if you think about it, by the time it reached 120, how many shares was I able to buy in total? I bought 1 lakh here, 1 lakh here. That means by the time it reached 120, how many lakh of orders, how many orders was I able to trade in total? I bought 1 lakh here, 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 which means I was able to buy in total 500,000 shares by the time it reached 120. Now, in this scenario, would you agree if I say that I was able to efficiently trade between 100 and 120? Would you agree? Now, in this scenario, was I able to efficiently trade between 100 and 120? Perfect. I was not able to. Here, I was able to in scenario number 2. Now I'm going to introduce you all to the rule number 2 of price behavior. The rule number 2 of price behavior states that the market always tends to fill the imbalance. Market always tends to fill the imbalance. Guys, take a screenshot, type done once you're done taking the screenshot. What is the rule number 2 of price behavior? Market always tends to fill the imbalance. Done? Perfect. So what does it say? The rule number 2 of price behavior states that the market always tends to fill the imbalance. What is imbalance? Here in this scenario, what is imbalance? The area between 100 and 120. The area which was not traded. This area right here is my area of imbalance. Now, what does the rule say? It states that the market always tends to fill the imbalance. Market tends to fill the imbalance. Now, one thing I want you to understand about institutions is that institutions hates when there are inefficiencies in the market. Institutions always wants to efficiently trade all the prices. They want to efficiently trade all the price points. So whenever there is an area of inefficiency left behind, whenever there is an area of imbalance left behind, institution will tend to come back and fill the imbalance so that during its way back down, the price between 100 and 120, which I was not able to trade previously, all those price points I will now trade. All these price points during its move back down, I will buy here, buy 1 lakh here, 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 1 lakh here. Is this understood? Is this understood? Why the price imbalances are getting filled? Because institutions always wants to efficiently trade all the price points. To get a little bit of clarity on this, I'm going to give you an example. If you haven't understood, right? I'm going to give you two scenarios. In scenario number one, what is happening? The price is going from 100. Sorry, price is going from 100 all the way till 120. Now, in scenario number one, what is happening? Let's say my target is 200. All right, my target is, as an institution, my target is 200. So even though I place my order at 100, I place an order for 100,000 here, my order gets filled at 120, and then the price continues heading higher, reaches 200, and I sell everything at 200. This is scenario number one. So what is happening? I place an order for 1 lakh here. My order, did it get executed at 100? My order for my buy order for 100,000, did my order go through at 100? No, my order got placed at 120, right? After that, let's say I place 1 lakh here, 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 buy 1 lakh, buy 1 lakh, buy 1 lakh, and I sell everything at 200 for profit. This is scenario number one. In scenario number two, again, same thing happens. It goes up, comes back down, and then reaches 200. So what is essentially happening here? I buy 1 lakh here. I buy 1 lakh, I buy 1 lakh here, 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 1 lakh here. And I sell everything at 200. This is scenario number two. In which scenario was I, as an institution, which scenario was I able to make more profit? Scenario number one or scenario number two? Obviously, scenario number two, right? Why? Because I was able to buy for cheaper. All this price which I was not able to trade previously due to the lack of liquidity, all those price points will now be traded. I am going to efficiently trade the price points which I was not able to efficiently trade previously. And then the price goes up, right? Type yes if you understand the rule number two of price behavior. Market always tends to fill the imbalance. Is this clear? Now I'm gonna give you all, I'm gonna show this to you all in chart. Okay. Let's see. Um, guys, can I consider this as an area of imbalance? Can I consider that as an area of imbalance? Is it fair for me to assume that trading did not happen inside this area? Right? Market was not able to trade in between that area. Perfect. Right? Trading only happened from here and then here. This entire area, there was no trades being placed. Right? This entire area is a void of liquidity. Right? Let's look at the next candle. What happened? The imbalance gets filled till here. Let's look at the next candle. Next candle. Guys, sorry, can I consider this as another area of imbalance? Yes or no? There's another area of imbalance. Here also trading did not happen, right? Let's look at the next candle. The imbalance gets filled till here. Imbalance gets filled till here. I'm going to extend my areas of imbalances. Okay. Can I consider that as another area of imbalance? Is that another area of imbalance? Yes. All right. Let's continue. What happened? The imbalance gets filled till here. Imbalance gets filled till here. Entire imbalance gets filled. Now, can I consider these areas as an area of imbalance. Are these imbalances, right? Now this entire area was an imbalance until it got filled till here, right? That imbalance got filled, and now I have an imbalance being left behind here as well. That also is an area of imbalance. Let's look at what's happening. The entire imbalance gets filled. I'm going to extend this. The entire imbalance gets filled, but now is this another area of imbalance? Is that another area of imbalance? Trading did not happen there. Perfect. We'll continue. What happened? The imbalance gets filled till here it's traded. Let's continue. Imbalance get traded till here. I'm going to extend this. The entire imbalance is traded. But now, is that a new set of imbalance? Is that a new set of imbalance in area where trading did not happen? Yes. Imbalance gets filled till here. Entire imbalance gets filled. This imbalance gets filled. But now, do I have another big area of imbalance? Perfect. What happens? The entire imbalance gets filled. Type yes if you understand this theory. Is this clear for everyone? Clear? Perfect. Now my question is, let's say you see the market create an imbalance like this. Just because you see an imbalance, next candle are you going to buy here thinking that market has to come back and fill the imbalance? Are you going to buy here thinking, okay, dude, I see an imbalance to the upside, so market has to come back and fill the imbalance? Are you going to do that? Absolutely not. Because what is the rule? Rule states that market always tends to fill the imbalance. Is that a necessity? Does all the imbalances have to get filled? Absolutely not. Right? Do you think an imbalance candle which was left behind by Reliance back in 2003, do you think that imbalance candle will ever get filled? Very, very unlikely. Correct. So imbalances does not necessarily have to be filled at all. Right? But market always what? Market always tends to fill the imbalance. Now I'll tell you why this is important. I'll tell you why this is important. Again, see, imbalance gets created, gets filled. Imbalance gets created, gets tapped. Imbalance gets created, entire imbalance gets filled. Imbalance gets created here, imbalance gets filled. Now, that's again, like I said, it is not a necessity that all the imbalance candles have to be filled always. No, I just wanted to understand that market always tends to fill the imbalance. All right, and I'll tell you why it's important as we move forward. Guys, till here, if rule number one, the entire logic of rule number one and entire logic of rule number two is perfectly clear for everyone, type yes. If everything is super, super crystal clear, the rule number one, rule number two of price behaviors. Very clear? All right. Now tell me how much time you need, because right now, once you come back, I'm going to teach you exactly how to buy and sell, where to enter, where to exit. I'm going to tell you once you come back after the break. Tell me how long you need the break for. It's okay. Again, I'm doing this just because you've promised me that I can take the session till 10:30. Right? That's the only reason I'm giving you break. If you're okay with this, I'm okay with giving you all a break. Okay, 10 minutes. Done. Done. 10 minutes, take a breather, get something to drink, get something to eat. What's the time now? It's 50, right? So come back by 9. All right, everyone come back by 9 p.m. and I am going to teach you exactly how to read the charts, where to enter, where to exit, the juicy bits. All right? Okay, done. I'll see you guys at 9. All right? Come back. Okay, is everyone here? Yes, yes. I need 350 yeses and then we shall continue. Wait, where is everyone else? Okay, people are still joining back in, I guess. Should I put in the group saying we are continuing or something like that? Hold. Hold. Is imbalance similar to fair value back? Fair value gap? No, it's not. See, see, the idea, the core concept is very simple. I mean, it's very similar, right? For example, if this right here is your imbalance candle, your fair value gap is going to look a little bit different. So I'm going to keep that as my imbalance candle. Let's say, do you want me to change the color? Let's say I have a first candle here, and then I have a wick here, and then I have a third candle here, and then I have a wick here. The area between the first and the third candle's wick, this area right here is called your fair value gap. Right, that's a fair value gap. Now, again, obviously, inside the fair value gap, also there is no liquidity. There is zero liquidity inside the fair value gaps as well, right? Now, again, guys, if it goes over your head, it doesn't matter. It's fine because quickly, I'm gonna quickly explain to you what's up. See, fair value gaps can do two things, right? It can either tap into your fair value gap, provide liquidity, and do a continuation, or it can tap into your fair value gap, provide liquidity, continue heading lower, invalidate your fair value gap, tap here, and then reverse. Right? These are the two things. So this is something called the inversion of fair value gaps. Now, fair value gaps can also be made into volume and gap imbalances as well. Right? Okay, guys, you know what? Can I give you all a few concepts which I need you all to learn by yourself, because again, I'm very limited with the time I have. We are barely scratching the surface of stock trading, and there is so much more which I would want you all to learn. So, can I give you all a few points which I want you all to research by yourself and learn by yourself? Can I do that? Will that be possible for you all? The concepts which I think is essential you learn before stepping into the market. All right. So let me take 2 minutes. Let me type it out and take a screenshot. All right. So we're going to start with obviously volatility contraction pattern, volatility contraction pattern, and then we'll get to VSA, which is volume spread analysis. Once you understand VCP and VSA, then you need to understand about faulty basis. And then we get to areas of liquidity, right? We need to understand a lot about liquidity sweeps and then peak rejections. And then you need to understand fair value gaps. And then Wyckoff schematics, very important, very core concept. And then volume slash gap balances. Then uh, demand and supply buildups. And what else do we have? Um, Let me see. Okay, order blocks, which is what I'm going to be teaching you, right? I'm going to be covering order blocks, so it's fine. I mean, you can do research on it a little bit more, but then I'm going to cover everything you need to understand about order blocks. Um, what else? Let me quickly um to start off with. Am I missing? Oh, yes. optimal trade entry, right? Also, if you want to understand optimal trade entry, you have to understand a little bit about premium, equilibrium, and discount zones, right? All right, guys, take a screenshot, type done once you're done taking the screenshot. Also, please read these two books. Very important. If you're coming to the market, I would highly suggest you trade these two books. Trade in sorry, trade like a stock market wizard by Mark Minervini. Also, Trading in the Zone by Mark Douglas. Two very good books. Please take a screenshot of this as well. All right, I want you to research by yourself, learn all of this before you seriously start looking into stock trading. All right, very important. Now I'm going to be covering a little bit of these. Don't worry. But then obviously all these concepts is going to take me some months to cover. What is Vico schematics? See, um, okay, I'm going to quickly walk you through what are Vico schematics. See, what I needed to understand about the market. Don't worry, guys. We'll get to the main part in a bit, right? We are just taking a little small tangent. Don't worry. See, market, right? Market always moves in basis of accumulation, reaccumulation, distribution, redistribution. Guys, one second. I'm getting a call. Hold up. 1 second. Hi. Sorry, guys. See, market, right? Always moves in basis of accumulation, reaccumulation, distribution, redistributions, right? Now, this right here is what we call a spring, right? See, technically, you will be having, okay, I'll get to it in a bit. So, accumulation is areas where the institutions are buying, right? So they are going to buy in small quantities. Why? Because if they buy everything together, what happens? A huge scandal gets created, right? Remember imbalance candles? Why is that happening? Because due to the lack of liquidity. So with whatever liquidity is available, market has to slowly accumulate their shares. And this is called a spring, which is a fake out before the actual move happens. Now these moves are called markups. Markup, right? And then we have distribution. Distribution is where the institution will start selling. They'll start booking profit in small, tiny areas. Bit by bit, market will distribute, and then the fall happens. And then the fall happens. This is redistribution, and these falls are called mark downs. Right now, usually retailers gets involved during a markup, which is not what you are supposed to be doing. You are supposed to read these schematics and understand where the market is, where the sign of strength is present, right? See, to give you a very quick example, right? See, if this right here is a buying climax, then you'll have a preliminary support, then have an automatic rally, and then you'll have a secondary test. You'll have multiple secondary tests, and then you'll have a spring, and then you'll have a sign of strength, and then the move up, right? So this is how essentially your Bicos schematic should ideally look like, right? This is your preliminary support. This is going to be your buying climax. This is going to be your automatic rally. This is going to be your secondary test. And this is an area where the testing actually happens. This is called spring. And then you have a sign of strength. After the sign of strength, you have the move up, right? Now, see, every this is not limited to time frames, right? Even if you go to Nifty, if you go to maybe 2 hour time frame as well, before every move happens, you will see that the market has to spend some time to distribute. Market has to spend some time to accumulate. Market has to spend some time to accumulate. Every single move that you see, market has to take some time to accumulate. Sorry, distribute. Market has to take some time to accumulate, and then the move up. Market has to take some time to accumulate, and then the move up, right? Now this is not necessarily restricted to your daily time frames or 2 hour time frames. The same goes for even in the small time frames. For market to create any sort of momentum, market has to first accumulate. Market has to, this entire area is an area of distribution. See, that is a smaller distribution. This also is an area of distribution. All these are distribution zones, right? So market has to spend some, market can't go like this, right? Market can't go like that. Market has to spend some time to accumulate so that institutions can enter bit by bit and head higher. But I'll quickly show you Wyckoff accumulation or distribution schematic, because I've, sorry, accumulation. I have experiment accumulation, right? Forgot. Okay. See, this is how your schematic should ideally look like, right? You'll have a selling climax, preliminary support, automatic rally, secondary test, spring, and then the sign of strength. Now, ideally, you're supposed to buy the sign of strength. Same thing is there for the Wyckoff distribution as well. See, this is your distribution schematic. Buying climax, preliminary resistance, automatic sell off, up thrust, secondary test, sign of weakness, and then the move down. Up thrust is going to be your fake out, right? Now, so if you want to learn about it, please research. It's a very important topic. I mean, not necessarily too important, but it's a very powerful tool. If you're able to understand, figure out Vyckoff schematics, things will get, your life will become so much more easier, right? Along with all those other concepts that I've given. Please read through it, go through it, go on YouTube, search what's up, do your own backtesting. See, I'll tell you how you should be backtesting, how you should be figuring things out. Everything I'll tell you in a bit. All right. Now, again, coming back to our core concepts. Now, so now I'm going to introduce you all to something called demand and supply zones. All right. Demand and supply zones. What are demand zones? What are supply zones? Very simple, right? First, again, obviously, before learning something, we need to understand the theory of what's happening. Why are we doing this? Right? I hope everything that I've mentioned so far, the entire theory is understood. I'm hoping you're not by hearting everything, right? I really need you all to understand the concept of what we are doing. I see, I'm sure there are YouTubers out there who's telling you, okay, when this happens, buy here. When that happens, sell here. When this pattern happens, sell here, buy here. No. I want you to understand the reason, the exact reason you're doing what you're doing, right? You need to understand what the institution is doing at all these areas, which is why you should be taking a trade to begin with. So understanding theory, understand the concept is very important, right? So what are demand zones? What are supply zones? First, let's try to understand the theory. So let's say the market is doing something like this, and market does that, and then let's say we have a, sorry, that little bit OCD I have, sorry. Let's say I have a big inefficiency candles. Let's say I have big inefficiency candles, big imbalance candles. Now, guys, logically, if you think about it, would you agree with me if I say that this base right here at the bottom, this base right here at the bottom, a lot of institutional buying would have happened here. Would you agree? A lot of institutional buying would have happened right here at this base. Would you agree? And that is the reason why the market created this big candle to begin with. Right? Right? Now, let's try to understand the logic of what's happening here. Now, let's say currently the market is here and I'm LIC. All right. Let's say I want to buy 500,000 shares right here. All right. So what I'm going to do as LIC is Without before even trying to place entire 500,000 orders together, initially I place an order. I'm going to break this in parts, right? I'm going to make this 300 plus 200. Okay. So now initially I'm going to take an order for 300,000. Now, the moment I placed an order for 300,000 shares itself, market created a big inefficient candle. It started creating inefficient candles, right? Now, pay very close attention. Was I able to completely trade the entirety of 500,000 here? Was I able to trade it? No. I was only able to trade how much? 300,000 shares. Which means 200,000 shares are still remaining to be traded. Now that 200,000 order by order is still here inside this base right here. 500,000 got traded here. Sorry, 300,000 got traded here. Remaining 200,000 is still remaining to be traded right here. This buy order is sitting there. Okay? Pending order is sitting there. Now, when the market comes back down, now I said when the market comes back down. Why does the market come back down? I'll be very impressed if someone can give me an answer. Why does the market come back down? To my base right here? Correction, gap, pending order, liquidity. No, no, no. Think about it. Why does the market come back down? Exactly rule number two of price behavior. What are these areas? These are areas of imbalances. Market will come back down to fill the area of imbalance, and it taps back into my base here. And what is sitting at my base? Remaining buy orders. So these buy orders will get executed, and what happens? Boom, market will continue heading higher. Now this base right here is called my demand zone. Type yes if you understand the theory behind what's happening inside a demand zone. The theory is clear. Perfect. The same ulta goes for supply zones, right? Let's say market is doing something like this, and then I have a big fall, big inefficient fall. Now I'm going to mark this. So this base is responsible for the fall, right? So inside the base, what is sitting there? Institutional sell orders. Lot of huge amount of institutional sell orders are sitting inside the base. So market will come back down, come back up to fill the imbalance area, tap into my base. What is sitting at my base? Huge amount of remaining institutional sell orders, and then what happens? Market goes down. Theory is clear. Can I show this to you all in chart? Perfect. Perfect. Can I consider this as a supply zone? What do you think? Big, huge inefficiencies started from that base. So what happens? Market comes, taps into my supply zone, heads lower. Correct? Similarly, we shall continue. Let's look at more examples. Can I consider this as an area of supply? Big inefficiency move started from here. Big inefficiency started from that base. So what is essentially happening? Market comes back. I'm going to extend to my base here. Taps into my base and heads lower. So what all inefficiencies are being filled? Pay very close attention here. I have inefficiency here, which gets filled. I have inefficiency here, which gets filled. I have inefficiency here, which gets filled. I have inefficiency here, which also gets filled, right? So market is technically coming back to fill my inefficiency. It'll tap into the institutional orders which are being left behind and again understand what's happening. So market, what am I seeing here? Market is tapping into the supply zone. Now, guys, what is this? What is that? Area of imbalance means market is likely to fill the imbalance. So market is tapping into my supply zone. Can I expect the since market is tapping into my supply zone where I know there will be a lot of sellers, can I expect the market to come back and fill this? Is that a logical assumption which I'll be making at that point? Right? So market comes back down, fills the entire area of imbalance. Right? So we are going to continue. Can I consider this as a supply zone? Big imbalance started right from that base here. So what am I expecting the market to do? Market's going to come back, tap, move down. I hope this is clear. Right? Now let's see a few demand zones. Oh, I ran out of candles to show you. One second. Let's go to 3 minutes so that I'll have more candles to show you. Can I consider this as a demand zone? So I'm going to extend my demand zone. What happens? Market comes back down, taps into this base right here. Institutional orders get executed. Boom, goes back. Right? I hope this is very clear. If you'll need more examples, I can give you all more examples. We can run out of candles. Let's go to 15 minutes. Can I consider this as a demand zone? What do you think? Can I consider that as a demand zone? Big demand zone, big impulsive inefficiency move up. So market comes back, taps into the base, heads higher. All right. Now, see, the fact of the matter is, if you get to a point where you understand, see, it's very easy. It's not that hard. Every single area of demand and supply, market will react to it at least a tiny bit. Everywhere there is a demand, market will try to react to it at least a tiny bit, right? See, market reacted from the demand, market reacted from the supply. Type yes if this is understood. This is 1 minute time frame. So market created a supply, market created demand, tapped into supply, tapped into demand, headed higher. Right? So this is how things work. Right? Moves based off of areas of where strong limit orders are. So these are called passive orders in the market. So in the market there are passive orders and active orders. This is caused by passive orders. Let's not get into all that. Now, obviously, by now you should know that all all the supply zones, for example, that right there is a supply zone. Did market respect my supply zone? Did market after tapping into my supply zone head lower, or did it break through my supply zone? What happened here? Did the market respect my supply zone, or did it break through my supply zone? It broke through the supply zone, right? But ideally market is supposed to tap and head lower. It didn't happen there, right? Again, for example, let's say um okay, see, that's the supply zone, but market did tapped in supply zone and started going down, and it took a demand from here as well, right? But see, there are situations. See, that's a supply zone. Is market tapping into my supply zone? Okay, did market respect the supply zone? Did market tap into the supply zone and fall? Or did it head higher? Or did it break through it? It broke through it. Correct? Similarly, again, this supply zone worked. See, that's a supply zone. Market tapped into supply zone and went back down. But again, that is not necessarily, see, again. So you'll reach a point where you're going to start looking at market in terms of ranges and not zones, but we'll get there. Now, again, see, that's a demand zone. Market did tap into the demand zone and head higher. Man, I'm trying to find a case where demand did not hold. Wait, okay. See, that's it. Can I consider that as a demand zone? Can I consider that as a demand zone? Did market tap into my demand zone and head higher there? Did market tap into my demand zone and head higher? Did it head higher or did it break through my demand zone? It broke through my demand zone, right? So we can't necessarily, just because we have a demand zone does not mean that we can buy immediately when it taps into every single demand zones. There are few things that we need to look for. There are few constraints, right? Just because you have a supply zone does not mean that the moment it taps into the supply zone we can immediately sell. We can't do that. There are few constraints. Now give me 2 minutes while I plot something. POI means point of interest. OB means order block. All right. Don't worry, I'm not speaking anything, Masa. Don't worry. All right. Now, now I'm gonna introduce you all to something called break of structures and change of character. What is a break of structure? What is a change of character? Let's try to understand. All right. Now, you all already know that market, if it does this, right now it's in an uptrending structure. Why? Because it's creating higher high, higher low, higher high, higher low, higher high, right? And it does this. Now, guys, the moment market breaks this low right here, what happens? The structure has shifted from an uptrending structure to a downtrending structure. Correct. The moment price breaks this low, what happens? The structure changes from an uptrending structure to a downtrending structure. Now, the level which the market has to break to change the structure from an uptrending structure to a downtrending structure is called your change of character. Correct. Now, currently, guys, after the change of character, what is the structure of the market? Is it uptrending or downtrending? Type quickly. It's in a downtrending structure. So right now market is in a downtrending structure. Now, guys, which level should the market break for this to again be an uptrending structure? Is it number 1, Is it number two or is it number three? It's number one. The moment it breaks this level again, what happens? The structure has technically changed from a downtrending structure again to an uptrending structure. Bro, I don't know why you are giving such content for free. Many were charging more than 10K. Figure, hey, I got you, bro. Don't worry. Now, so this right here, so right after market breaks this, what happens? Your structure shifts from a downtrending structure to an uptrending structure, which means that level is a change of character. Now, right now, what is the structure? Right now, market is an uptrending structure. Again, if it breaks this, what happens? Then we have a change of character. This right here is a change of character. Guys, type yes if you understand what is a change of character. Is this clear? How to plot your change of characters? Is that understood? Perfect. Now, what is a breakout structure? See, breakout structure, there are internal breakout structures, external breakout structures. No, ignore all of that. I'm going to make things very simple for you. Right? See, a breakout structure shows continuation of the trend. As in, if the market is in an uptrend, if it continues, if it continues this right here, what is it doing? It is breaking this high, but it's continuing the trend, which means this right here is a breakout structure. If that is a breakout structure, is that also a breakout structure? Yes, it is. Why? Because it's continuing the trend, right? That also is a breakout structure. Now, guys, what is this? After the change of character, market is in a downtrend, right? Which means that is what? What is that? It is continuing the downtrend, which means this level break is called a breakout structure, which means that also is a breakout structure, which means this also is a breakout structure. Is the difference understood? Can I make you all do an assignment with me right now? All right, let's see. Okay, now, now, what is that? That's a breakout structure. What is that? What is that? Exactly, good. That's a change of character. Now it's in a downtrend. What is that? Breakout structure. What is that? That's a breakout structure. What is that? Perfect. Awesome. That's a change of character. Oops. What is that? Perfect. That's a breakout structure. What is that? That's a change of character. What is that? What is that? Check very properly. What is this? See, after the breakout structure, right now it's in a downtrend, which means that's a change of character. And then it again breaks. I have two change of characters together. Now it's again in an uptrend. So that also is a change of character. Got it? What is that? Perfect. That's a breakout structure. That's a change of character. That's a breakout structure. That's again a change of character. That's again a breakout structure. Guys, now type yes if you understand exactly what change of characters and breakout structures are. Awesome. Now I'm going to show this to you all in chart. Guys, what is that? Breakout structure. What is that? Perfect. That is a change of character. I hope this is clear. I hope this is clear. Right? Now, guys, I need you all to take a screenshot. Type done once you're done taking the screenshot. Take a screenshot, type done once you're done taking the screenshot. Type da, everyone type. Where is everyone else? Type. Where did your energy go? Is 2.5 hours too long for you to learn a very important concept? Awesome. Hey, nice. Full energy. All right, perfect. Awesome. Now let's see what's happening here. Which timeline is better for to understand? This is 1 minute, 5 minute. Very good question. Now, see, in the market, there is something called fractality that exists. Markets are fractal in nature. What I mean by that, what I mean by that is everything that I'm going to be teaching you from this point onwards, it will work exactly the same in all the time frames. If I'm teaching you something in the 1 minute time frame, it'll work exactly the same in 5 minute time frame, 15 minute time frame, 1 day time frame, 1 hour time frame, 30 minute time frame, 2 hour time frame. Markets are fractal in nature. I'm sure you have come across YouTube gurus who claim to know how to trade, telling you that okay, dude, this strategy will only work in 5 minutes. This strategy should not be used in 30 minutes. Have you come across things like that? Strategies which only works in one single time frame? Yes, yes. Wrong, rubbish. That person have no idea what he's talking about. There should never be a case where your system is only working in one certain time frame. No, markets are fractal. If your system is not working in other time frames, it means you have a failed system. Your system does not simply work. Right? As simple as that. So please understand that whatever I'm going to be teaching you from this point onwards, it'll work exactly the same across all the time frames. What about FEG? Even for FEG, everything. All right. Now, coming back to very good question, Macha. Whoever asked me that. I'm so sorry, bro. I don't mean to disrespect. I don't remember the name. So this supply zone. Why have I plotted that supply zone? Because imagine that somewhere on the left, market would have created this. Just imagine this is there. Big inefficiency candles, and that is the reason I have considered that supply zone in the first place. All right. So just imagine that is there. I'm not going to be plotting this right now. So I have my supply zone. Now, guys, I have a breakout structure and market taps into my supply zone. Again, obviously, what am I expecting from my supply zone? There is huge institutional pending sell orders here, which will get absorbed, resulting in the market to move down. So my question to you is, why can I not sell at the first tap of supply zone? Why not? Why can I not just immediately sell and enter the trade here and sell here the moment it taps into my supply zone? Why can I not do it? Is my question. Anyone? Anyone? I'll be very impressed if someone can give me the answer. It could break out, it might continue, no buyers. No, not what I'm looking for. Guys, what is the structure of the market after breakout structure? Is it uptrending or is it downtrending? After the breakout structure, when it's tapping into the supply zone, is the market in an uptrend or is it in a downtrend? It's an uptrend, right? Right after the breakout structure, what is the trend right now? Before while it's tapping, Ignore everything that's happening to the right. You don't know what's going to happen after that. Till here, when it's tapping into my supply zone, market is doing what? Market is in an uptrend. And the general thumb rule of the market, what is this? I don't even have to say this, right? You never sell when the market is in an uptrend. You never sell when the market is in an uptrend. You never buy when the market is in a downtrend. As simple as that. So, what do you need? You need a shift in structure. You need the structure to change from an uptrending structure to a downtrending structure. And what do we want for that? We need a change of character, right? So, do we have a change of character here? Yes, we do. So, right after the change of character, now we know for a fact that market has shifted its structure from an uptrending structure to a downtrending structure. Now, what do we want? Now, we need the market to tap into OB 2.0. What is OB 2.0? Now, just like how you have a big supply zone, right? You know, the reason why I've considered that as a supply zone is because you already know for a fact that market might have done something like this previously, somewhere to the left, right? That is the reason we have considered that as a supply zone to begin with. Now, your OB 2.0 is after market taps into the supply zone, while it's coming back down to create change of character, market will do something like this. Market will create another area of supply zone. It will create a smaller supply zone, which means it will have imbalance candles. It will have imbalance candles like this. Now, again, I'm going to repeat. After market taps into my supply zone, it'll move down a little bit. It'll create another area of imbalance. It'll create another supply zone. So, the supply zone which is responsible for creating the change of character is called your OB 2.0. So after the change of character, you wait for the market to come back and again tap into OB 2.0. And that is very, see, we're going to remove all of it, right? We're going to ignore all of that. So after change of character, you're going to wait for the market to come back and tap into OB 2.0. And that is where you are going to sell. You're going to keep your stop loss right above that supply zone, and then you will be targeting this. This is going to be your TP1. TP is take profit. You'll be having multiple take profits, right? Take profit 1, take profit 2, take profit 3. This is going to be your take profit number 1. Type yes if you understand the theory of what you're supposed to be doing. Is this clear? Oh, damn, I thought you'll be confused with OB 2.0. Hey, dude, I'm glad. I'm so glad that you understand this. But it's fine. If you don't understand the concept of OB 2.0, don't worry. I'm going to show all of these multiple examples, whatever time frame you want, whatever stock you want, whatever instrument you want. I'm going to show you examples. All right? So that way you'll understand how to plot your OB 2.0. Now, can I show this to you all in 1 day time frame? Can I show how to do this in 1 day time frame? Yes, OB means order block. Sorry. OB means order block. POI means point of interest, right? This is where, this is the area, this is the point where we are interested to get into a trade, right? So, same thing, right? So, let's see. Let's go to Tata Motors itself. We'll go to 1 day time frame and then we'll zoom and then we'll do this. Where I made. Okay. Can I um okay. Can I consider that as a supply zone? What do you think? Can I consider that as a supply zone? Yes. Can I consider that as a supply zone? Perfect. Awesome. Right? Now, now, so this is where things get interesting, right? So if you see here, let me just quickly zoom in. That's my supply zone. That is my supply zone slash order block slash point of interest. Correct? Now, if you see here, my entry might be somewhere around 520. My exit might be somewhere around 540, which means, around 520 to 540. 20 rupees is what I'm risking for this trade. Now, how do we understand if my trade is good enough, is rewarding enough for me to be involved in it? How do we understand that? So now I'm going to introduce you all to something called risk to reward ratio. Now, your risk to reward ratio means how much money you are going to be risking and how much reward you are looking at. And your risk to reward will always be a minimum of 1 is to 2, which means if you are risking 10k on this trade, minimum profit you are looking at is how much? If you're risking 10,000 rupees for this particular trade, the minimum target profit should be 20,000. If you're risking 1,000 for the trade, the minimum target should be how much? It should be 2,000. Now, I'm sure y'all have come across people claiming that they have doubled their capital in one single day. And that is gambling. Okay, so I don't know how many of y'all follow me on Instagram here. If when you're seeing me making this 1.2 lakh in profit, this 1.2 lakhs that I've made in this one single day, it is not with a capital of 1.2 lakhs. Right? I did not double my capital. Don't get me wrong. I'm not doubling my capital. My entire capital is not just 1.2 lakhs. Right? So when you see people on the internet claiming that they have doubled their entire capital in one single day, that means they have basically risked their entire capital in one single trade. Which means if one single trade goes wrong, your entire capital is wiped out. So you are not going to do anything stupid like that. You all are smart adults. We are not greedy people. We know for a fact that stock market is not a get rich quick scheme. We are here to stay and we will only play by the rules. And what are the rules? That you will never risk more than 2% of your capital per trade. If your entire capital is 1 lakh, how much should be your maximum risk? If 1 lakh is your capital, your maximum risk is 2002 percentage. So if your risk is 2 percentage, the minimum target should be how much? 4 percentage. So if you have a 1 lakh capital, you will be risking 2,000 per trade, and per trade you are looking at 4,000 as a minimum target. Now this is minimum. The trade 1 is to 2, right? You're not going to be looking at 1 is to 2 trades. You'll be looking at 1 is to 4, 1 is to 12 in some cases, right? You're looking at much better, bigger risk to reward rates. But the minimum that I want you all to keep is 1 is to 2. Now, why are we doing this? Why are we doing this? Now, think of it this way, right? Let's say you take 10 trades. Let's say you take 10 trades, and out of 10 trades that you take, let's say 6 trades were a losing trade. More than half of your trades, 6 trades you lost. You were only right out of 10 times. Let's say you were only right 4 times. Let's say you only have a 40% win rate, which I think is a very bad win rate either ways, right? But regardless, let's say you only have a 40% win rate. All right. What is your risk to reward? 1 is to 2. Every time you are winning, you are making 1 hour, right? You are making 1 hour. Every time you're losing 1 hour. And every time you're winning, you're making 2 hour. What is 1 hour? What is your risk? 2 percentage. right? Keep that in mind. So 6 times you lost, which means you lost 6 hours. 4 times you won, which means 4 into 2, 8 hours. How much is 1 hour? 2%. You lost 12%, you made 16%. You are in a profit of how much percent? You are in a profit of 4% regardless, which means even if you have a 40% win rate, if majority of the trades that you take are wrong, you will still remain in profit if you just make sure you follow this one very simple general thumb rule that every good trader follows. Is this understood? Risk to reward, this entire theory is clear for everyone? Perfect. Awesome. Now, coming back to Tata Motors. Now, if you see here, my entry would be somewhere around 520, exit somewhere around 540. Not really, because I'll be trading at OB 2.0, but before that. So I am risking 20 points for this Tata Motors trade. If I'm risking 20 points, I should be targeting at least how many points? I should be targeting at least how many points? 40 points. Now, I don't necessarily want to be, targeting 40 points in a 520 rupee stock. I don't have to. I want to refine my trade. What will I do to refine my trade? I'll tell you. I'll tell you exactly how you'll be refining. Um, so I'm gonna go to the smaller time frame, 30 minutes, right? What is it? 18th November 2021. Hold up. I'm gonna go to 30 minutes. Calendar. 18th November 2021. Okay. Now, now, if you see here, right? So this was the supply zone which I have marked in the daily time frame. Now I'm in the 30-minute time frame. Now that I'm in the 30-minute time frame, guys, can I reduce my supply zone from this big area right here till here? Does that seem logical? Yes. Do you understand what I've did? Very logical. This right here, this is the supply zone. This is where the impulsive move started. Right? Now I'm going to put it in bar replay. Let's see what's going to happen. That is my supply zone. Right? Now, what am I assuming the market to do? Market is going to come back to fill that area of imbalance right here and tap into my supply zone. That is basically what I'm expecting out of the market. Right? So we're going to continue. Hold up. Let me just quickly. So, okay. I'm going to mark whatever lows it's create. I'm going to mark the lows just because I'm going to target that. Don't worry. I'll show you what I mean by that. Okay. It's going to tap, I think. So I'm going to move my target to that. Now we're going to wait for the market to come and tap into this supply zone right here. We're going to keep extending the supply zone. Okay. Market has tapped into my supply zone. Guys, what is this? What is that? What is that? That's a breakout structure. Guys, for there to be a change of character, market has to break this. Would you agree? Would you agree? Perfect. Now I want the market to come back and break this. Do I have a change of character? Do I have a change of character? Yes, I do. I'm going to mark my change of character right here. Change of character. What is the next step? I need to plot OB 2.0. What is OB 2.0? A supply zone which is responsible for creating the change of character. Do you here see a supply zone which is responsible for creating the change of character? Yes, I'm going to mark that supply zone. This right here is what? That right there is the supply zone which is responsible for creating the change of character. Right? Now I'm going to extend this. I'm gonna do that. I'm gonna keep that as my supply zone. All right. Now, so this is what that right there is my OB 2.0. Can I take the trade here? Can I sell? Can I sell here? Perfect. I'm gonna sell right here. Oops, sorry, wrong. I'm gonna sell right here. Now, if you see here, that area right above my OB 2.0 is going to be my stop loss. And what is going to be my TP1, take profit one? This area right here. Now, before I enter, I have to check what is my risk to reward ratio. Is it more than 1 is to 2? Is it more than 1 is to 2? How much is it showing? It's 1 is to 3.34. So right now I'm risking 521, 527. I am only risking 6 rupees, which is completely fine. We initially were trying to risk 20 rupees and capture 40 rupees. Now we are only risking 26 rupees because, not even 6 rupees, 5 rupees because we have refined our trade. Correct? So again, risk to reward is more than 1 is to 2. I have an OB 2.0 tap, all good, change of character, finish, done. Right? And now currently I am in the trade. Now this is going to be your take profit 1. Done. Take profit 1 is done. So just because this is a daily time frame supply, right? Remember the low that I've marked? I'm going to take that as my last target, which is 1 is to 16 hour right there. If you see risk to reward, 1 is to 16 hour, right? And I'm going to extend. And then we'll see. I'm going to extend. Okay. Do you all think it's going to hit my target or do you all think it's going to hit my stop loss? What do you think? Be very honest. Do you all think it's going to hit my stop loss or do you all think it's going to hit my target? What do you all think? Stop loss, stop loss. What does so much distrust in me? That's a volume imbalance. Ideally, it'll come back down. I'll extend this. I'll extend this. I'll extend this. That's an area of imbalance. It'll come, market should ideally come back up to fill that area of void. Filled. Again, area of imbalances. Sorry. Again, area of imbalances will come back down to get filled. Filled. Now it should ideally come back down and take. Done. Guys, type yes if you understand the trade. Type yes if this is understood. Now, see, you don't necessarily have to keep this as your target. You're not going to do that. You are going to be looking your what is going to be your target when you're backtesting? This right here. This right here. Whatever low is created by the change of character, that is going to be the target. Is this clear? Understood, but this trade is days long, bro. Okay, done. Don't worry, Macha. I'm gonna teach you in all the time frames. Don't worry. Do you think I'm just gonna let you leave like that just by giving you one example? No, da. Okay. What am I doing? Go to 1 minute time frame. Why is it not letting me go to 1 minute time frame? What is happening? Let me just quickly reload. Okay. Let's see. I'm gonna show you easy examples first, right? And then we'll take it from there. Let's see here. Oops, what happened? Now, see, obviously, if it's in the 1 minute time frame, it's going to be a little bit more tricky compared to your higher time frame because 1 minute time frames is a lot more erratic than your smaller time, sorry, than your higher time frames, right? But I'll show you. Let's see. Mm, okay. It might be a little hard for you to figure this out, But this is tapped. Oh, it doesn't tap us, so it doesn't matter. It's okay. I'm gonna give you more examples. That one was much more easier because everything was very inefficient there. I'll show you easier ones. Hold up. Let me figure it out. Okay. There we go. Type yes if this is understood. Breaker structure, tap, change of character, supply zone, tap, move down. That's a change of character. I just haven't. Do you want me to type it? Breaker structure, tap, change of character, supply zone, which is responsible for creating the change of character, tap, move down. Is this clear? Is this clear? Perfect. What about this right here? Uh, I have a breaker structure, so change of character happens much later, so that's fine. I'll give you better ones. Did I run out of candles? Let's go to 2 minutes. See, I do see things, but it might be kind of hard for you to follow, so I'm not really sure, right? But either ways, type yes if this is understood, or if you don't understand this micro change of character, then that's a change of character you can look for. Type yes if this is clear. Oh, damn, nice, nice. I thought it's gonna be confusing for you all. So what is this? So that is going to be my supply zone, breaker structure, tap, change of character, tap back into the supply zone, which is responsible for creating the change of character, and the move down. Is this understood? Now, see, I'll tell you how, what you should be doing, how you should be backtesting this. See, when it comes to trading order blocks, right? I don't want you all to put money into this. This is only a system which is very essential for you to get started with backtesting and getting a feel of how the market functions. When you get to actual, real, serious trading, you won't necessarily be waiting for the market to come back and tap into these zones or areas. You're going to be looking at key strength in the market, right? You're going to be looking at market in terms of where strength lies, where how accumulation works, where you find market creating buildups, where key areas lies. See, for example, right? Let me quickly show you an example. See, we are going to look at market in terms of areas of supply which is being taken out by areas of buildups, and then we need some sort of smaller demand buildups, right? Or volume imbalances. You're ideally going to be looking at the market like this instead of, so you're going to be wanting to understand market in terms of basis of accumulation and distribution structures, so that it's going to be much more easier because your one tiny base and a move. So for example, this move right here, um See, this move right here does not hold much strength if you think about it, because market does not necessarily accumulate and form bases to make the move, right? So there is not much accumulation going here, which means market does not necessarily have to hold this, right? But again, like I said, for the time being, this is the only thing which I want you to look out for. Looking at market in terms of supply and demand zones, not buildups, zones, right? Now, I'll tell you how you should be backtesting this. What I've done right now, when I'm showing you examples, I am doing something called hindsight analysis. What do I mean? What do I mean by that? I already know what's happening to the right. So it's very easy for me to show you that okay, this is happening, okay, tap happened here. Why am I saying this? Because I know what's happening. I am seeing it. I know what's happening to the right. I know that the system is working. And that is the reason I'm giving you examples to begin with. I don't want this to be the case. When you're backtesting, I don't want you all to know what is happening to the right because there is something called confirmation bias. I'm not going to go too much into neuroscience because that in itself in our program that we have, again, obviously don't misthink me. I'm not trying to sell my course. I'm just telling you that trading psychology, understanding neuroscience is something that we take maybe an entire six hours of content, right? So I'm not going to get too much in depth into confirmation bias, but understand that once, see, right now you're going to leave this session thinking that okay dude, I want to backtest, I want to learn about order blocks, I want to see market reacting at order blocks, breakout structure, change of character. So your brain already has a bias. Your brain is constantly searching for your bias to be confirmed. So when that happens, what your brain will do is when you're going through the chart, your brain will conveniently ignore the times when your system failed. Your brain will only focus on the times your system worked, which I do not want. So what I want you all to do is use TradingView and subscribe to the premium feature, which is bar replay right here. If you don't want to do that, you can use, there are multiple other platforms that will let you do this for free. Bar replay. Take bar replay, put bar replay, and start. So this way you have no idea what's going to happen to the right. Right? You have no idea what's going to happen to the right. Now you will do bar replay. Now you will do this every time you see some sort of demand or supply zones being created, you are going to mark it. Every time you have some sort of demand or supply zones being created, you are going to mark it and see how the market is going to react. See, I have a demand zone here that is being created. That's a very tiny demand zone. I have a breakout structure. Now I have a change of character. Then after the change of character, market tag back into my demand zone, and ideally it should. Okay, it's not heading higher, so this failed. Right? So similarly, now once you have a supply zone, you mark the supply zone. You'll again continue. So I have a demand zone. I want to see if the market is going to give me a breakout structure, change of characters. I'm going to see if it moves. Doesn't. So this demand zone is invalid. So I'm going to mark my supply zone here. I'm going to continue. I'm going to keep doing this. I'm going to keep doing this. Every time I have a demand zone, I'm going to mark the demand zone. Every time I have a demand zone, I'm going to mark the demand zone. Okay, I have a supply zone. I'm going to mark the supply zone. Sorry, I'm going to mark the supply zone. I want to see how the market will react from there. Broke the supply zone. Will again continue. See, that's my supply zone which I had marked previously. Now, if I was looking at hindsight analysis, then I will already know that market is going to react from my supply. Right? I don't want that. You are supposed to do it in the live market. Right? So you're gonna keep doing this, keep doing this. Every time you have a demand, you're gonna keep marking this. Again, you'll continue. Every time you have a demand, you're gonna keep marking. Every time you have a where did it go? Okay. Go chart web is free. But you know what the problem is? See, end of the day, the reason I'm making you all do this in trading view itself is because you will reach a point in your career, sorry, in your trading career where your main charting platform is going to be trading view. You are not going to be using your broker chart to trade. Your broker you will only be using to place orders. Trust me, the charting platform would be different. It'll most probably be TradingView. So since your charting platform is going to be TradingView, I want you all to backtest everything in TradingView so that your brain is very familiar with these candle, how the candle looks like, how the platform looks like. Your brain is very familiar. So for that reason, everything that you're going to do, see, this is the kind of, see, so that is a demand buildup. So that's a key area. Technically speaking, we are, I mean, if you understand a little bit more about distribution schematic, this is where you're ideally going to go short at, not at order blocks. I mean, see, for me personally, I'm just being completely honest. I personally do not use order blocks to trade, but if you're a beginner, I believe that order blocks is a very good tool to get you started with. Right now, that does not mean that I want you all to start putting money and trade order blocks. Not at all. Do you all remember the points that I've given a few minutes back, an hour back? I need you all to go through all those points before you start putting money in the market. Until then, we, like I said, in these 3.5 hours, we have barely scratched the surface of what there is to understand about stock trading. Right? So there is so much more to learn. You are a child at the moment. So in terms of what there is to understand about stock trading, so please learn a lot, read a lot, backtest a lot before you start putting actual money in the market. Right? So yeah, again, you keep doing this. Every time you have a supply zone, you mark the supply zone and see how it's going to react. See how it's going to react. And you continue. If you don't have breakout structure change of character, it doesn't matter. It's invalidated. And then you continue. But why is my candles getting stuck? Every time you have a supply zone, you mark the supply zone. Every time you have a demand zone, you mark the demand zone. So again, every time you if you already have access to everything that's happening to the right, then there is no reason for you to do this. Right? Your brain simply would ignore the times your system failed, and that is very, very, very wrong in terms of backtesting. This is not how you backtest. Cool. Does this theory work in current market? See, ideally, see, once you understand a little bit more about stock market as a whole, you'll know for a fact that order blocks are, see, technically, I don't know if this will go over your head. If it doesn't, if it does, it's fine, right? Don't worry about it. So let's say I do have a supply zone, right? Now, even if I don't really have a breakout structure or change of character, and if it just goes through my supply zone, now this is called a purge area, right? Purge area where there is liquidity. It's basically market, cutting out the weak hands, and then we have the next available move down, right? This is called the purge block or the purge supply. Ideally, this is what is more, which has more strength than my initial order block there. But let's not, let's not make trading more complicated than it has to be. Y'all are just starting out, and initially, I would prefer y'all start backtesting order blocks. All right, the rest of it, we'll get to it. We'll get to it later, right? There are, again, just go through everything that I've told you. Do you come live? Yes, yes, Macha. I do trade live daily. How do you take a trade? Can you show that on yesterday's brother? See, no, you won't understand. So there's no point because if I explain how I'm trading, there is so much more things, layers that's linked, which I'll have to break down first, right? Which difference between supply demand zone and it's basically the same thing, right? It's just that if for you to have a proper order block first, there has to be a purge in liquidity, and then the move back down. But don't worry, you don't have to go in depth like that. Every time you have an impulsive move down, consider it as order blocks. All right, so we need to check every stock to, yes, when you're backtesting, backtest every instrument you can find. Backtest every instrument you can find. Cool. Now, okay, before I let you all go, see, the time is 10:15. We're going to end by maybe 10:30. So the fact that y'all listen to me talk about trading for three and a half hours means that you will definitely start trading very, very soon. Otherwise, bro, me personally, I wouldn't listen to someone teach something for 3.5 hours. That's a very long time. So if you are still here, I already know how much passionate you are about stock trading. Now, since you're passionate about stock trading, there are few things which I want you all to understand before I let you all go. Now, number one, the time window which I want you all to give yourself is 1 year. Now, the reason I'm telling you all this is because once you already have a profitable system, it will take you 6 months to master the system. This is after you have a profitable system. First you should learn a system that is profitable, right? Once you have a profitable system, it will take you 6 months to just master the system. Then the next 6 months you'll take to understand how your brain functions, understanding and sorting out your trading psychology. Now you must be wondering, bro, why do I need 6 months to figure out how my brain functions? Trust me, it will take 6 months at the minimum to give you a very quick understanding of things, right? Again, I'm so sorry for the tangent. If you want to leave, you can leave. It's fine. Now, see, inside you, right? I'm going to take a name, Arjun, right? Inside Arjun, there are two people. There is Arjun. There is Arjun 1.0 and there is Arjun 2.0. Inside Arjun, inside the brain of Arjun, there are two Arjuns. Arjun 1.0 and Arjun 2.0. 1.0 is the part of the brain which I like to call the monkey brain or the limbic system. 2.0 is the part of the brain which is called the prefrontal cortex, your decision maker, right? Your limbic system is responsible for making us feel our all these raw hunter gatherer emotions, right? Feeling fear, feeling greedy, feeling hopeful. Let's say, for example, let's say I'm seeing 10,000 profit or 15,000 profit in my account in my P&L statement, and then at 15,000 I'm ideally supposed to exit, but then I won't exit because at that point I'm going to convince myself that, bro, 15,000 is not enough. What if it reaches 20,000? What if it reaches 25,000? So let's not exit. I'm going to hold, right? So this is happening because you get greedy, right? And this same happens when you go into loss. Ideally, you're supposed to exit once you have a 2,000 loss, but you won't exit at 2,000 because you will convince yourself, your monkey brain will convince yourself saying, bro, hold a little bit more. It might come back to profit. It might come back to profit, right? This is all your monkey brain behavior, right? Your limbic system is making you do this. So you will reach a point in your trading career where all your trading decisions will be taken by your prefrontal cortex, your decision maker. Initially, when you start out, all your trading decisions will be taken by the monkey brain. Your bottom trade, your FOMO trade, you trading out of fear, out of greed, everything. It's all done by monkey brain, and you will trust me when I say this. You will go through that phase, and it takes time. It takes a lot of understanding of neuroscience and how your brain functions for you to actually give control of your trading decisions to your prefrontal cortex, your decision maker. All right. Now, see, I don't want to explain about neuroplasticity and how your brain can be rewired and all that. Again, it's a very whole different tangent. If at all, guys, is there anyone who's already part of masterclass here? Anyone? Who might have maybe just joined or something like that. Okay. See, Sri Harsha, you're gonna but honestly, I don't understand why you're here in the bootcamp to begin with, but either ways. So you're gonna learn about it, right? Of how your neuroplasticity. Long story short, it is possible to rewire your brain. It is possible to rewire your brain. There are certain methods to do that, and from up, people say that it takes 21 days to build a habit, which is wrong, which is stupid. It takes 45 days, right, to rewire your brain to make sure that this one neural pathway is stronger compared to other pathways which we want to be detached from. So point being, all in all, it's gonna take you, see, 6 months is the time which it'll take you to understand, sorry, to make sure you're sorted with your how your brain functions, provided you know a lot of neuroscience and understand how your brain reacts and what it does, everything that has to do with how specific areas of your brain functions. I feel like I know I'm sounding like a science teacher, biology teacher, but I know how important it is for you to understand how your brain functions, how behavioral psychology works. Very important, right? For if I want, I can give you all a YouTube um, reference. I'm sure at least half of you all might already know this. Please go and search for Andrew Huberman on YouTube. I think the name of his YouTube channel is Huberman Labs. Cool. Go through his videos, understand how your dopamine receptors work. I mean, this is for all the people who have been trading for maybe 2 years, 3 years, right? I'm sure you are currently struggling with trading psychology. Please make sure you treat your brain like a baby. Baby, that's a very small baby, your brain. You need to take care of your baby. Understand the reason why it's crying. Your baby might be crying because it's hungry, because it's feeling fear, because it's confused. You need to know what your baby needs. You need to learn how to take care of your baby. Until then, you're not going to be a good trader, right? As simple as that. I mean, I can't rant too much, it'll take too much time. We're going to be going completely off topic. But point being, the window that I want you all to give yourself is 1 year. Number one. Number two, the money that you are going to start trading with initially, you keep it at the very minimum. Very minimum. As in, trust me when I say this, the money that you are going to start trading with, whether it be 1000 or 1 lakh, the money that you are going to start trading with, you will 100% lose it. You will definitely lose it. The money that you start trading with, right? We are humans. This is the first time in the market. We'll feel greedy, we'll feel hopeful, we'll go through that entire, that again, see, no matter, no matter how much you tell, okay, money is not important, money doesn't buy happiness and all that bullshit, we know it's how important money is. So if you are doing something which directly involves us making and losing money, the emotional roller coaster that you'll be going through is going to be very intense initially. So the money that you're going to start trading with, you will lose it. So make sure the initial capital that you start trading with, make it very minimal, because you will try to experiment. No matter how much you convince yourself saying that, okay, I know what I'm supposed to be doing, this is the only thing that I'm going to do. No, you will sit and try to experiment. Trust me, right? You will try to, oh, what if I do this? What if I do this? I mean, I don't mind holding, I can do this, I can do this, I can try holding this way. You will definitely try to experiment, and experiment will definitely lead you to losing money. So make sure you keep your initial capital to the minimum, right? These are the two things which I want you all to do. That's pretty much it, ladies and gentlemen. Signed up for trading. See, no, why? See, first of all, bro, I don't see the fact that you are listening to this webinar right now. I'm gonna assume that you do not know how to trade. If you do not know how to trade, why would you register for our funding exam? Tell me that. Because see, funding exam, first of all, it is $1,000. Let's say you pay the $1,000 and you sit for the funding exam. Once you sit for the funding exam, you don't know how to trade, because if you knew how to trade, why would you come attend this session? Get it? So why do you want to chumma waste this thousand by registering for this funding exam? So okay, imagine you register for the funding exam and we give you a $10,000 account. If we give you a $10,000 account, will you be able to maintain it? Will you be able to maintain this 10,000? You'll eventually end up losing it, right? So what is the point? Don't don't register for the funding exam until you know how to trade. Okay, I agree. Once you understand, once you're good at stock trading, once you're good at reading the chart, go for it. Not a problem at all. Right? Go for it. Get the funded account, trade the funded account, get the payouts. Completely fine. Cool. All right. Any other questions? Okay, guys, before I let you all tell us about your course, man, I don't want to pitch my course here, bro. I don't want to feel like, those sales agents who's gonna, make and sit you listen to my sales script and make you, sign up to the course, bro. I don't want to do that. See, it's a 3.5 month course where I mean I'm just gonna be very, very short with it, right? It's a 3.5 month program where So 3.5 months is just the theory where we are going to cover everything from basics with till whatever you need, and that's the theory. And then you get lifetime access to our Discord server. I'll be trading live, all that stuff, right? You'll be amongst a big traders community, and this traders community we have bunch of VCs. From morning till evening, you get to talk to me, other mentors, other traders. It's a very big fun space. But is this concept working in Bitcoin? Yes, it works. Whatever I'm teaching you, it'll work exactly the same across every single financial instrument that can be represented in candlesticks, even bonds and crypto, forex, doesn't matter. How do I get? See, I feel like in the group there will be a link which will be put. Fill the form. Someone from my team will get in contact with you. He'll walk you through the entire program. If you feel like it's worth it, go for it. Now, but like I said, there is nothing you can't learn by yourself. I personally believe that there is nothing you can't learn by yourself. So if you feel like, okay, dude, this fee is too much, then please, by all means, like I said, you can learn from the internet. I feel like, dude, if you want to build a rocket, I feel like there is enough information on the internet to learn how to build a rocket, right? So you just have to make sure. See, bro, the only problem is that a lot of people on YouTube they have no clue what they're teaching, right? All these people, man, I've seen people, SEBI registered people who are claiming to make so much money and all. Bro, these people are, I'm when I see someone plotting this, no, I immediately know that that person knows shit about the market. So it's kind of hard to find. Uh, See, again, I'll tell you a general advice, right? Whatever you learn from whichever guru out there, make sure you sit and backtest properly to make sure what he's teaching is correct. Sit and do your own research and make sure you sit and backtest, and whatever he has taught you, backtest for 3 months. See if it's working out. Only then step into the market. Cool. Who's your mentor, bro? I've been doing this for 9 years, more than 9 years. I don't have my market is my mentor. Cool. Done. Okay, before I let you all go, another question, guys. Do you all feel like this boot camp was worth the $200 that you've paid? Do you feel like you're gonna start looking at the market differently from tomorrow onwards? I would like see. I'm not taking a video or anything like that, right? I just want to know if you all found it interesting. Hey, thank you all so much, guys. Awesome. That's so sweet. Thank you all so much. Insta ID, yes. Insta ID is Ritvik. Ritvik. That is my Instagram ID. Also, a quick disclaimer, if you follow me on Instagram, you will start getting messages from other people with my similar profile, with my similar number of followers, and they'll text you saying, "Okay, I am. If you give me this much money, I'm gonna make you this much percentage returns." Stuff like that, right? You'll start getting scam messages from a bunch of other people. So please make sure. See, if you, I'm never going to DM you first. If you send me a message, I'm definitely going to reply back. But then if you don't, I am not going to send you a message first. So if some Ritvik is sending you message, please know that it's not me. Right? This guy will also have my same number of followers. Also, he'll have, because I feel like you can buy fake followers or some shit like that, dude. But the reason I'm having to say this is because this one person lost around 7.5 lakhs because he thought he was paying me, and I was supposed to give him 50% returns or something like that. So just as general, yeah, 168K followers. Okay, sorry, 168K, 168K followers, right? Yeah, and I have a verified that blue check mark, right? So that's also there. So just disclaimer: don't respond to anyone who's gonna claim to be me. When will we get the recording? Right after the session, or maybe tomorrow. Are you Malu? Yes, I am. Oh, Malu. What is the current bias of Nifty and Bank Nifty? Very bearish, Macha. Why do you think so? We'll see. We'll see what the market does, right? Hopefully, after the budget, if market starts giving some sort of momentum, we'll see. But nothing yet. Hey, thank you so much, Shifin. Thank you so much. Oh, hey, thank you, Parth. All right then, guys. I'll see y'all if you're going to be part of the program. I'm going to see y'all next weekend because I'm going to be responsible for covering teaching the entirety of the SMC. Forex is going to be handled by someone else, right? We have see all these people who we've hired. They're not they're not some random people we find from somewhere, right? These people are legit funded traders who are handling a lot of money, right? So all our forex traders are funded. People are going to be trading. So all these people are very 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 talented people who are going to be teaching you other stuff. I'm going to be teaching you SMC, but rest of equity and forex and all that, there are different people. Cool. Again, because I'm a pure FNO trader, right? I don't trade equity. I'm a pure FNO trader. Cool. All right then, ladies and gentlemen. All the best. Now, if at all you want me to go through your trading screenshots, please DM me your trading screenshots. I will be more than happy to go through it. All right, DM me your trading screenshots. I'll be more than happy to go. But the problem is, dude, see, right now Instagram has this weird feature where if you can't send images, I don't know when they launched that. You have first I have to accept the request, and then only you can send the images. I don't know why that's the case. So I'll tell you a workaround with that. So when you're sending me a message, don't send hey because you won't be able to send me a message after hey. So tell me what is the scene. Type an entire sentence first so that I know what's up. Because if you send hey, chances are that I won't be replying to you because I get too many hays. So it's very hard to reply to everyone just like that. So if you're telling me, if you're typing if the first message is, bro Ritvik, there's a screenshot which I want you to review, send that first so that I can accept your request so that you can send me the screenshot. All right, done. All right then, guys. I'll see you all next weekend. Cheers, guys. Bye bye. Hey, thank you, guys. Can you do a live trade? Bro, I trade live daily, da. What do you mean? Okay. Bye, guys. Bye, guys. Cheers. Good night. Cheers. Bye. Where you trade live inside the server or Discord, our community, right? The traders community inside there. Okay. Cheers, guys. Bye bye. Link it'll be put. Just fill the form in WhatsApp. Everything regarding the program, the community, the live, everything. It'll be someone from the team will call you and let you know. All right. All right. Cheers, guys. Bye bye.